in duty. I propose to reduce BCD subject to conditions on methylene diphenyl diisocyanate MDI for manufacture of spandex yarn from 7.5 to 5%. Furthermore, the export duty structure on raw hides, skin, and leather is proposed to be simplified and rationalized. Precious metals. To enhance domestic value addition in gold and precious metal jewelry in the country, I propose to reduce customs duties on gold and silver to 6% and that of platinum to 6.4%. Other metals, steel and copper are important raw materials. To reduce their cost of production, I propose to remove the BCD on ferronickel and blister copper. I am also continuing with nil BCD on ferrous scrap and nickel cathode and concessional BCD of 2.5% on copper scrap. Electronics. To increase value addition in the domestic electronics industry, I propose to remove the BCD subject to conditions on oxygen-free copper for manufacture of resistors. I also propose to exempt certain parts for manufacture of connectors. Chemicals and petrochemicals. To support existing and new capacities, I propose to increase the BCD on ammonium nitrate from 7.5% to 10%. Plastics. PVC flex banners are non-biodegradable and hazardous for environment and health. To curb their imports, I propose to raise the BCD on them from 10 to 25%. Telecommunication equipment. To incentivize domestic manufacturing, I propose to increase the BCD from
What you waiting for? 1, 2, 3, 4, 5, 6, 7, 8. I hold the power to create. I have the world to regulate. My style no one can replicate. What you waiting for? 1, 2, 3, 4, 5, 6, 7, 8. Got style no one can replicate.
Looking to take the next step in your career? Then you have to get this AWS course on Udemy. It gets you up to date on the latest tools and techniques so you can learn AWS fundamentals and pass your exam. Take this course at your own pace, on your commute, after work. So get this course now.
Improve taxpayers' services, provide tax certainty, and reduce litigation while enhancing revenues for funding the development and welfare schemes of the government. It has been our endeavor to simplify taxation. We have taken a number of measures in the last few years, including introduction of simplified tax regimes without exemptions and deductions for corporate tax and for personal income tax. This has been appreciated by taxpayers. 58% of corporate tax came from the simplified tax regime in the financial year 22-23. Similarly, as per data available till now, for the last fiscal, more than 2/3 have availed the new personal income tax regime. Comprehensive review of the Income Tax Act. I am now announcing a comprehensive review of the Income Tax Act 1961. The purpose is to make the act concise, lucid, easy to read and understand. This will reduce disputes and litigation, thereby providing tax certainty to the taxpayers. I will also bring down the demand embroiled in litigation. It is proposed to be completed in 6 months. A beginning is being made in the finance bill by simplifying the tax regime for charities, tedious rate structures, provisions of reassessment and such provisions, and capital gains taxation. Simplification for charities and TDS. Two tax exemption regimes. The two tax exemption regimes for charities are proposed to be merged into one. The 5% TDS rate on many payments is being merged into the 2% TDS rate and the 20% TDS rate on repurchase of units by mutual funds or UTI is being withdrawn. TDS rate on e-commerce operators is proposed to be reduced from 1 to 0.1%. Moreover, credit of TCS is proposed to be given in the TDS to be deducted on salary. Further, I propose to decriminalize delay TDS up to the due date of filing statement for the same. I also plan to provide a standard operating procedure for TDS defaults and simplify and rationalize the compounding guidelines for such defaults. Simplification of reassessment. I propose to thoroughly simplify the provisions for reopening and reassessment. An assessment hereinafter can be reopened beyond 3 years from the end of the assessment year only if the escaped income is 50 lakh rupees or more, up to a maximum period of 5 years from the end of the assessment year. Even in such cases, a time limit of 6 years before the year of the search, as against the existing time limit of 10 years, is being proposed. This will reduce tax uncertainty and disputes. Simplification and rationalization of capital gains. Capital gains taxation is also proposed to be hugely simplified. Short-term gains on certain financial assets shall henceforth attract a tax rate of 20%, while that on all other financial assets and all non-financial assets shall continue to attract the applicable tax rate. Long-term gains on all financial and non-financial assets, on the other hand, will attract a tax rate of 12.5%. For the benefit of the lower and the middle income classes, I propose to increase the limit of exemption of capital financial assets to 1.25 lakh rupees per year. Listed financial assets held for more than a year will be classified as long-term, while unlisted financial assets and all non-financial assets will have to be held for at least 2 years to be classified as long-term. Unlisted bonds and debentures, debt mutual funds, and market-linked debentures, irrespective of holding period, however, will attract tax on capital gains at applicable rates. Taxpayer services. All the major taxpayer services under GST and most services under customs and income tax have been digitalized. All remaining services of customs and income tax, including rectification and order giving effect to appellate orders, shall be digitalized and made paperless over the next 2 years. Litigation and appeals. While our concerted efforts to reduce pendency of appeals at various appellate fora are beginning to show good results, it will continue to engage our highest attention. To dispose of the backlog of first appeals, I plan to deploy more officers to hear and decide such appeals, as large tax effect. For resolution of certain income tax disputes pending in appeal, I am also proposing Vivad Se Vishwas Scheme 2024. Further, I propose to increase monetary limits for filing appeals related to direct taxes, excise, and service tax in the tax tribunals. High Courts, and Supreme Court to 60 lakh rupees, 2 crore rupees, and 5 crore respectively, with a view to reduce litigation and provide certainty in international taxation. We will expand the scope of safe harbor rules and make them more attractive. We will also streamline the transfer pricing assessment procedure. Employment and investment. I have a few proposals to promote investment and foster employment. First of all, to bolster the Indian startup ecosystem, boost the entrepreneurial spirit, and to support innovation, I propose to abolish the so-called angel tax for all classes of investors. Second, there is tremendous potential for cruise tourism in India. To give a fillip to this employment-generating industry, I am proposing a simpler tax regime for foreign shipping companies operating. Third, India is a world leader in the diamond cutting and polishing industry, which employs a large number of skilled workers. To further promote the development of this sector, we would provide for safe harbor rates for foreign mining companies selling raw diamonds in the country. Fourth, to attract foreign capital for our development needs, I propose to reduce the corporate tax rate on foreign companies from 40 to 35%. Deepening the tax base. I have a couple of proposals for deepening the tax base. First, security transaction tax on futures and options of securities proposed to be increased to 0.02% and 0.1% respectively. Second, for reasons of equity, I propose to tax income received on buyback of shares in the hands of recipients. Other proposals. To improve social security benefits, deduction of expenditure by employers towards NPS is proposed to be increased from 10 to 14% of the employee's salary. Similarly, deduction of this expenditure up to 14% of salary from the income of employees in private sector, public sector banks, and undertakings opting for the new tax regime is proposed to be provided. Indian professionals working in multinationals get ESOPs and invest in social security schemes and other movable assets abroad. Non-reporting of such small foreign assets has penal consequences under the Black Money Act. Such non-reporting of movable assets up to 20 lakh rupees is proposed to be depenalized. Other major proposals in the finance bill relate to withdrawal of equalization levy of 2%, expansion of tax benefits to certain funds and entities in IFSCs, and immunity from penalty and prosecution to Benamidar on full and true disclosure so as to improve conviction under the Benami Transaction Prohibition Act 1988. Personal income tax. Coming to personal income tax rates, I have two announcements to make for those opting for the new tax regime. First, the standard deduction for salaried employees is proposed to be increased from 50,000 to 75,000 rupees. Similarly, deduction on family pension for pensioners is proposed to be enhanced from 15,000 to 25,000 rupees. This will provide relief to about 4 crore salaried individuals and pensioners. Second, in the new tax regime, The tax rate structure is proposed to be revised as follows. 0 to 3 lakh rupees, nil. 3 to 7 lakh rupees, 5%. 7 to 10 lakh rupees, 10%. 10 to 12 lakh rupees, 15%. 12 to 15 lakh rupees, 20%, and above 15 lakh rupees, 30%. As a result of these changes, a salaried employee in the new tax regime stands to save up to 17,500 rupees in income tax. Apart from these, I'm also making some other changes as given in the annexure. As a result of these proposals, revenue of about 37,000 crore, that is 29,000 crore in direct taxes and 8,000 crore in indirect taxes will be foregone, while revenue of about 30,000 crore rupees will be additionally mobilized. Thus, the total revenue foregone is about 7,000 crores annually. Mr. Speaker, sir, with this, I commend the budget to this august House. Jai Hind.
Item number 2. Item number 2.
Sir, with your permission, I rise to lay on the table the following statements under Section 3 of the Fiscal Responsibility and Budget Management, FRBM Act 2003, medium-term fiscal policy cum fiscal policy strategy statement and macroeconomic framework statement.
Item number 3.
Sir, with your permission, I rise to move for leave to introduce the Finance Number 2 Bill 2024.
प्रश्न ये कि विधेयक को पूरा स्थापित करने की अनुमति प्रदान की जाए। जो सदस्य इसके पक्ष में हाँ कहें, जो सदस्य विरोध में ना कहें, मेरे विचार में निर्णय हाँ वालों के पक्षवा अनुमति प्रदान की जाती है। माननीय मंत्री जी, अब विधेयक पूरा स्थापित करें।
Sir, I introduce the bill.
Item number 4.
The Union Territory of Jammu and Kashmir budget. Sir, I rise to present a statement, Hindi and English versions, of the estimated receipts and expenses
कल बुधवार दिनांक 24 जुलाई 2024 को प्राप्त 11 बजे तक के लिए स्थगित की जाती है।
जूम आउट करने बोल।
Introduction. The people of India have reposed their faith in the government led by Honorable Prime Minister Shri Narendra Modi and re-elected it for a historic third term under his leadership. We are grateful for their support, faith, and trust in our policies. We are determined to ensure that all Indians, regardless of religion, caste, gender, and age, make substantial progress in realizing their life goals and aspirations. Global context. The global economy, while performing better than expected, is still in the grip of policy uncertainties. Elevated asset prices, political uncertainties, and shipping disruptions continue to pose significant downside risks for growth and upside risks to inflation. In this context, India's economic growth continues to be the shining exception and will remain so in the years ahead. India's inflation continues to be low, stable, and moving towards the 4% target. Core inflation, that is non-food and non-fuel, currently is 3.1%. Steps are being taken to ensure supplies of perishable goods reach markets adequately. Interim budget. As mentioned in the interim budget, we need to focus on 4 major castes, namely the Garib, Mahilaye, Yuva, and Annadata, the poor, women, youth, and the farmer. For Annadata, we announced higher minimum support prices a month ago for all major crops, delivering on the promise of at least a 50% margin over costs. Pradhan Mantri Garib Kalyan Anna Yojana was extended for 5 years, benefiting more than 80 crore people. Administrative actions for approval and implementation of various schemes announced in the interim budget are well underway. The required allocations have been made. Budget theme. Turning attention to the full year and beyond in this budget, we particularly focus on employment, skilling, MSMEs, and the middle class. I'm happy to announce the Prime Minister's package of 5 schemes and initiatives to facilitate employment, skilling, and other opportunities for 4.1 crore youth over a 5-year period, with a central outlay of 2 lakh crore rupees. I will speak about them shortly, while more details may be seen in the annexure. This year, I've made a provision of 1.48 lakh rupees, 1.48 lakh crore rupees for education, employment, and skilling.
माननीय वित्त मंत्री श्रीमती निर्मला सीतारमण।
Honorable Speaker, I present the budget for 24-25. Introduction. The people of India have reposed their faith in the government led by Honorable Prime Minister Shri Narendra Modi and re-elected it for a historic 3rd term under his leadership. We are grateful for their support, faith, and trust in our policies. We are determined to ensure that all Indians, regardless of religion, caste, gender, and age, make substantial progress in realizing their life goals and aspirations. Global context. The global economy, while performing better than expected, is still in the grip of policy uncertainties. Elevated asset prices, political uncertainties, and shipping disruptions continue to pose significant downside risks for growth and upside risks to inflation. In this context, India's economic growth continues to be the shining exception and will remain so in the years ahead. India's inflation continues to be low, stable, and moving towards the 4% target. Core inflation, that is non-food and non-fuel, currently is 3.1%. Steps are being taken to ensure supplies of perishable goods reach markets adequately. Interim budget. As mentioned in the interim budget, we need to focus on four major castes, namely the Garib, Mahilaye, Yuva, and Annadata, the poor, women, youth, and the farmer. For Annadata, we announced higher minimum support prices a month.
But they have raised the STT on FNO, which is to discourage therefore derivatives trading, which should become a concern. Both the governor and the SEBI chairperson had spoken about this.
Yeah.
So those are the big the sort of measures. Positives also, the angel tax, the much reviled angel tax has been scrapped. The corporate tax rate has been reduced for foreign companies 40 to 35%. There's been some minor, which minor reliefs to the taxpayers in the below 20 lakh range, as long as you're part of the new tax regime.
Yes.
That's a saving of 17,500 rupees, which will be, I mean, that matters for people. No reliefs on home loans, etc., which I didn't expect. Some of the participants early in the morning were expecting that, but home loan.
I want to take a minute to also flag off the further slip in the markets. Right now, another 100 points down. In fact, the last 2-3 minutes that we've been chatting, I've seen this change from 145 points dip to now more than 250 points.
How much has the
shaved
Nifty
off.
fallen over?
Right now, down to 50 points. If we could show it to our viewers as well, if we could pull up the way Nifty and Sensex are,
No, so that's the reaction to the
playing
capital gains tax.
And also the FNO STT, do you think that also has played?
Not so much. It was expected.
Okay.
The government clearly, I mean, there have been remarks that from the SEBI chairperson that that a lot of the derivatives trading is coming in the way of capital formation and is going into speculation. So that was expected. What was perhaps not so expected was a hike in the capital gains tax. A lot of market participants were vociferous about it. But I mean, the government has clearly taken a different call. There were hints of that in the economic survey. See, the theory is that why would a capital gain from sale of mutual funds or sale of shares be not taxed the same rate of income? Income tax rate is, well, it depends on your tax slab. It is 40% under at the highest tax level, or 30% at at levels just below that. So how is that different from salary? If salaries can be taxed at 30% or 40%, what is so special about income from selling shares or houses or so on and so forth? That's a theoretical argument, and it's fair enough. The issue which the policymakers have to consider is that India is in a competitive situation. Foreign portfolio investment, we are competing with Hong Kong, we are competing with Singapore, we are competing with China, and those jurisdictions do offer lower capital gains tax than India. So that's the reason why capital gains tax have been low. In fact, some jurisdictions, especially in Asia, in the Asia Pacific region, have zero capital gains tax, or so that is also the top income tax rate at around 40% is a high income tax rate. Of course, the 40% tax rate has not been enforced, but clearly the government has taken a view that it does needs to. There is a huge, value addition which investors get from the market. Their portfolio values are increasing.
The Exchequer wants a
The Exchequer wants a slice.
Want to come in here,
as and when you realize that income, when you sell mutual funds.
Nandita is also here. I think she wants
right. Just want to come in here. The capex figure has been maintained at 11.11 lakh crore rupees, and we can see all these railway stocks reacting to it. Stocks like IRFC, IRCON, they've all slumped in trade, 7 to 8% kind of cut coming in. What are you making of all the macro numbers that have been announced in terms of capex, in terms of receipts, as well as the fiscal deficit figure, right, below 5%? So market was working with a figure of somewhere around 5%. For FY25, it is at 4.9%. Take us through, what your sense is as to how the entire setup is going forward. 4.5%, that was for FY26. the FM has said that they will look at a lower number vis-a-vis 4.5%. So that should be good news. If you set aside all the market-related announcements that have been made in terms of taxation. So overall, this looks like a good growth-oriented budget. Would you concur with that, Bodhi?
Yeah, it is a growth oriented budget. See, the fiscal deficit number will be welcomed by the market. 4.9 is, in fact, a little lower than what was expected. The expectation was around 5%, right? And the interim budget actually proposed 5.1 as compared to 5.6 in the previous fiscal. So 4.9 will be welcome. 4.5 in next year, and I think she's talked about bringing it down to 3% over the subsequently, as 3% is the number in the FRBM framework. I mean, there's no magic about the 3% number. It's derived from the Maastricht Treaty. If you, but anyway, let me not go into ancient history. But yeah, so budget, the government, I mean, the markets will welcome that. I think it's also important for India to meet these fiscal deficit and to be conservative on the fiscal deficit front. Further, she's uh, talked about bringing down the debt to GDP ratio. So all these parameters, fiscal deficit and the debt to GDP ratio, which are interlinked, is important because the rating agencies, because we want an upgrade in our rating from the rating agencies over a period of time. We've now part of the world's major bond indices. So from that point of view, these are numbers which will be welcomed by those parts of the market. And I think, I mean, it's a fiscally prudent budget. I mean, the capital gains tax hike, while the market may not like it, will add to the government's exchequer. So I think that's, yeah. So I think those are welcome measures.
Right. Before we move further, just want to look at what the markets are really doing at the current juncture in terms of losers and gainers. Some of these PSU names have taken it on the chin. The likes of ONGC, Coal India, Power Grid, all of these stocks feature among the losers. Have the likes of Hindalco, L&T, BPCL. Some of the auto names like Bajaj Auto, Tata Motors are under pressure. On the flip side, you have I think ITC was one stock that I saw was among the gainers. uh, Gainers are few and far between. Titan, that's one stock. Of course, we've had customs duty cut on gold and silver. So, Titan, top nifty gainer at the current juncture, 4% up. ITC is the other one. I think in the fine print, we'll get to see what the government has really done with tobacco taxation. But for now, ITC is up 3.5%. Tata Consumer, HL. So, all these consumption related stocks have gone up. Of course, we've had this announcement of standard deduction going up from 50,000 to 75,000 for the new tax regime. So some more funds in the hands of common man, people who of course follow the new tax regime. So all of these consumption related stocks are doing well. Dr. Reddy's, Hero Motors, some rural facing stocks also doing well. Britannia. Aside of that, you have some bank names also doing well. But in terms of priority areas, urban development, space economy, financial assistance for Sikkim, Assam, and then package for Andhra as well. Has the FM or has the government really been able to dole out enough for their coalition partners as well? On that front, how would you really look at the budget, Bodhi?
Yeah. I think the budget was should have met the expectations of both the partners. I think there was a big package for Bihar, lots of announcements from Bihar sprinkled throughout the budget. Delivery, development of a lot of infrastructure in Bihar, in eastern states in general, but in Bihar in particular, of religious tourism, religious sites. So there was also a subvention. So the special package, as the economic survey made clear, is not constitutionally possible. What they're going to do, however, is that loans from multilateral agencies, essentially the tab will be picked up by the center, to put it simply, for both Bihar and Andhra Pradesh. So that's the way the special package is being done. So I think the allies will be happy. I think, on the point that you made earlier on the capex spend being kept at the 11.1 trillion rupees figure. I think that was expected, and I think, nonetheless, the some of the infrastructure stocks have declined somewhat because I think the markets are falling overall. I think that's really what is happening. And as you said, but because the budget is clearly intended to boost consumption, particularly consumption at the bottom of the pyramid, broadly speaking. I think that is why some of the stocks are rising.
And boost has it got, because Nifty FMCG is the only
Only, yeah.
bright spot
Yeah.
right now, one and a half.
Same thing happened on election verdict day as well, right, guys? We saw the HUL rise 6% on a day when the Nifty was down 6,000 points. So yeah, consumption at that point of time also came as a buffer. In fact, it came to the rescue, and today as well, the same is happening. I think we have Gaurav as well joining in at this juncture. Gaurav, I was just listening to our pre-FM speech chat where you had spoken about how the government should focus on job creation, employment, education, skilling. In terms of that, how would you really rate this budget? Because we have seen the FM announced a record 1.5 lakh crore for education, employment as well as skilling.
Absolutely. I think this budget. The focus is clearly on job creation. Some of those jobs will probably will be created over the medium term, not an immediate. But the intent clearly, the government has signaled this intent that job creation remains a primary priority area for this government. And then we have seen how. And there's some creative policy making that was a display during the budget speech. So one of them, of course, was the internship program, where corporates will now be allowed to use up part of the CSR funds for engaging or employing interns for with a salary of 5,000 rupees a month for 12 months. Essentially, what it does is that it skills a large number of young people and also enables them to earn some money. And for corporates, there's no extra money that they're going to spend. So it essentially comes from the 2% CSR fund that they were using for a variety of other programs. So that is one part of it. So far as jobs are concerned, MSMEs have been incentivized to create more jobs. Jobs clearly remains a primary focus area. Also agriculture, for instance, we just heard what the finance minister said about using digital public infrastructure for a digital crop survey, and finally, creating climate resilient varieties, which is something that this government has been talking about, because climate change has reached right at our doorsteps, and this is something that we can only ignore at our own peril. So this is one priority area. Now, climate resistant varieties could well be a precursor for diversifying the crop basket away from the grain bowl. Punjab, for instance, should not be cultivating paddy given the level of water, given the level of groundwater that it has, because paddy requires knee-deep water. And we have seen over the last few years how farmers' resistance to any kind of reforms that the government has sought to bring about in a farm sector has run into serious resistance from the farming community, and they have their own reasons too, probably. But this is something that the government has said that let's try and get a long-term solution to both incentivizing farm income, that is incentivizing farming as an economic activity, and also trying to deal with climate change, which is rapidly affecting crop produce, also affecting farmers insured income, because you don't have any certainty. If there is a weather shock, farmers are unable to deal with it. This is something that the government has said. The results of most of these will be felt and be seen in the medium term. But the government has made it very clear this budget is about jobs. This budget is the government's signal that it wants to create jobs by the millions. It's not about tens or thousands. And those jobs will have to come from the MSME sector. The large corporations will have to pitch in. The internship program is an example of that. And the jobs that will have to come in will come both from the public and the private sector and the small industries too. So jobs remains a priority area. Clearly, markets are unhappy. But on the fiscal consolidation side, the government has again demonstrated that it wants to toe the line. She has again walked the talk on fiscal consolidation. From 5.1% announced in the interim budget, she has set a rather steep target. And please do bear in mind that we are already almost 4 months into the financial year. So effectively, if you have to bring down the fiscal deficit to 4.9% of GDP, you have only 8 months to achieve that. And that's quite an ambitious, steep target. But the government is very clear that it will toe the fiscal consolidation line. It is not going to deviate from the fiscal glide path, 4.5% by FY26 and much lower beyond. I was a little disappointed because the finance minister did not give out a medium-term fiscal deficit target and did not return to the practice of actually projecting those targets, which was kind of paused a couple of years ago. But nonetheless, one would expect that the fiscal deficit will progressively come down to closer to 3%, which was a pre-COVID target before it was reset again.
Gaurav, would you be disappointed that the capex figure has been maintained, or would you say that that was something that you were expecting? Because the government had fiscal room to do so, right, to increase capex, which is why I think some of the disappointment is clearly visible. We've seen some of the PSU stocks, tank in trade, the railway stocks in particular. But do you think the government had, the fiscal room to perhaps just about bump it up by, a fair bit, not a fair bit, slightly. Do you think that should have been the case, or do you think it's maintaining it at 11.11 is something that bodes well?
So 11.11 lakh crore that was announced in the interim budget is something that I would have expected to remain unchanged, because there are two reasons for it. One, the effective capital expenditure is actually still close to 13 lakh crore, because if you account for the interest-free loan that the government, what is called the grants in aid to state for capital expenditure, that the government is going to give to state government to support the infrastructure asset creation activities. So the effective capital expenditure is still about 13 lakh crore. And the government is left only with about 9 months. So if you have about 8 months, so if you have to raise the capital expenditure, then you have 8 months to use up that capital expenditure. That would not have come. We had seen previously also some in a few years, in a couple of years, where the budget of the capital expenditure actually could not be spent by the time the year ended, because capital expenditure in infrastructure follows with a certain time lag. So 11.11 lakh crore is a figure that was probably factored in, and I would not have expected the finance minister to raise it in this budget. If the capital expenditure has to go up, it will probably go up in the next full budget, which is around just about 7-8 months away from now, 6 months in fact to be away from now. So that is one. But that said, this government had a fiscal elbow room of more than 1 lakh crore, because the RBI bonanza had come in by the time she was preparing for this budget. What she has ended up doing is that she has actually used a large part of that money, a significant part of that money, to reduce the fiscal deficit, and so that you use up that money to actually accelerate your fiscal consolidation path. If you reduce the fiscal deficit coming down from 5.1% to 4.9%, actually eases up, frees up 60,000 crores of extra borrowing from the market. So the government will not go down that road to borrow that 60,000. What it does is that it frees up that amount of money for the private sector to borrow, and also enables the government to bring down the fiscal deficit.
Gaurav, I want to interrupt you for a moment. Shashi Tharoor is giving his initial reaction on the budget. Let's cut across to him.
I myself had recommended it to Sri Arun Jaitley more than 5 years ago. Finally, it has happened. I'm glad that's being done. We must have more investment coming in to generate more jobs. But otherwise, I find very little in terms of any good creative ideas when it comes to generating more jobs in our economy and more opportunities for young people and for those at the bottom of the pyramid to improve their incomes. We will have to study the budget in much more detail, but I would say it's an underwhelming budget.
Sir, how do you see this budget?
I think
किया गया है उसमें बिहार को स्पेशल आर्थिक पैकेज दिया गया है, इस पर आपका क्या कहना है?
देखिए, मैं कल ही बता रहा था।
Back to you, Nandita.
Right. Just was going through the changes announced, the personal taxes in the new tax regime. Standard deduction has been hiked. The tax slabs have been changed a bit, tinkered with a bit. But no announcement as such on the old tax regime. Do you think, there's high time that the government does something with the old tax regime as well? Because that does incentivize, investments under various sections. So do you think, I mean, there should have been something for people who are still, subscribing to the old tax regime? Gaurav, this one's for you.
Yeah, Nandita, I think that's very unlikely. Gaurav, I think, will back me up on that. I think that's very unlikely, because the government is clearly, the new tax regime is the tax regime, is the default tax regime. They want to keep it that way, and they want to encourage people to move to the new tax regime. If you look at, that's the default setting. So I don't think they will do anything under the old tax regime. They want people to move away from the old tax regime. The reason why people are in the old tax regime is that if a person has a housing loan, you get that 2 lakh rupees break on interest, and also health insurance you can take. You can claim benefits under the old tax regime. Those are not available under the new tax regime. So some people, a lot of people will stay on the old tax regime for some time, but they should not expect any further the 2 lakh limit to go up, although the housing industry has been clamoring for it for quite some time. I don't see that happening. I think the government is quite clear that the new tax, that they want everyone to move to the new tax regime, which is less, which are in fact somewhat lower rates and no exemptions.
Right. The budget has been good for jobs, high on political priorities as well. You've had the government or the finance minister outline 9 priority areas as well. It's been a little tough for investors, but any area where you feel that the budget is lacking, or that the government could have perhaps done more, to unburden the middle class.
So, just a point on the income tax changes, on the individual income tax changes. You asked the question why the government, what's the government's plan to do with the old tax regime? One thing that she announced in the budget was a comprehensive review of the existing income tax system, that the Income Tax Act, or what is called as the IT Act 1961. I would assume that by the time that review comes along, maybe in a year or two, that is when the government is going to probably announce a sunset clause to the old income tax regime, which is when by the time exemptions will be done away with, deductions, many deductions will be not done away with, but we'll have a probably neater, more organized and standardized, easy to administer, and more importantly, easy to understand income tax system. The 1961 Income Tax Act has gone through several amendments. Every finance bill, there is almost an amendment in the income tax laws and rules. That is due for a long overhaul. An attempt was made about 15 years ago to bring a direct taxes code. Some of those proposed direct taxes would have come along in the successive budgets, but I think it's about time to actually completely overhaul India's income tax regime and come out with a neater, simpler, easy to administer income tax code of sorts, which the finance minister announced that the government is going to work. And because when she said that she's going to announce launch a comprehensive review of the income tax regime and the Income Tax Act 1961, this is probably what we are looking at. And I think she's waiting for that time, and the government is waiting for that time for the review to take place and the overhaul to be announced, which is when the old income tax regime will get set into a sunset kind of a time. On the other aspects of the budget, I think the government signals its intent on infrastructure, which has strong economic multiplier effects for spinning jobs and multiplying income. That will continue. Bihar and Andhra Pradesh remained focus areas, as was expected. More so Bihar, because it find more mention than Andhra Pradesh in the budget speech. Very, very big on jobs, very big on MSMEs, very big on agriculture. But one important thing, however, is that we need to notice that a large number of the schemes that was announced, a large number of the measures that was announced in this budget speech also found significant mention in the BJP's manifesto launched in April, just before elections, the first phase of elections had started. And so clearly the strike rate and the conversion from the manifesto to the budget, it was also true in 2014. It was also held true in 2019 and continued again in 2024, which is something, say for instance, the DPI on agriculture was mentioned in the manifesto. Most of the MSME schemes was also mentioned in a manifesto, and many other schemes related to other areas too. So manifesto remains the guiding playbook of sorts for the BJP so far as its economic policy is concerned. But one thing is certain: this is the 11th year of the BJP government, of the current NDA government, led by Prime Minister Modi, and its outlook remains, philosophy remains fiscally conservative. From a pure public finance point of view, they are public finance purists, and that is why we see, despite the RBI bonanza that came in during the start of this financial year, she hasn't used that to loosen her purse strings and go on a welfareist kind of a spree. Instead, use that to actually bring down the fiscal deficit.
Right. There's something for the startup community as well. Of course, this budget will bring cheer to the startup community, given the fact that the FM has abolished tax. I beg your pardon. Uh, Coming off of funding winter, do you think this paves the way for higher or more startup investments in the country? How do you expect the landscape to pan out here on?
That's for me.
Gaurav?
Yeah, so the angel tax, it was long expected that the angel tax will be abolished, and something that the startup community will gladly welcome. And I think it was about time, because it was some kind of a regressive tax, because the angel investors and the VC community and the PE community as is actually playing a pivotal role in helping our startup and the entrepreneurial culture prosper and flourish in India. You cannot be taxing them for doing that, because they are coming in at a place where no one else is paying money to entrepreneurs. There is no risk capital that is being made available to entrepreneurs to actually start their enterprise and create employment. So angel tax was some kind of it was some kind of a punitive measure, essentially trying to penalize someone uh, who's bearing a risk capital, who's bearing a risk for the capital. So if you can't be doing that forever, so this is something that should be very, very positive for the startup world, coming as it does during a very long and extended. I mean, we have gone through 2 winters. We're again going into another winter on the seasonal side, and this one just hope that this kind of turns around, the funds start flowing in. There's another thing that has happened, which will be a positive for the startup community, is that the corporate income tax rate for foreign companies has been brought down to 35%, which means that any startup or any startup enterprise that is seeking funds from foreign investors or through a foreign location, the foreign investor will ends up selling out a majority stake. The foreign investor actually will only be liable to 35% of corporate income tax than previously, which is lower than the previous rate, which is again going to be a big positive for the startup community. All in all, for startups, yes, it's good. Markets, it's not that good, because no one would have expected short-term capital gains tax as well as long-term capital gains tax across asset classes to go up. But the finance minister has gone ahead and do it. For jobs, it's quite good, and I think it's very unlike her previous budget speeches. This budget speech is also very long on detail. So you have a lot of details about many policies. In previous budget speeches, not just hers, you would see policy announcements being made and the details coming much later. In this case, there are even micro details of how policies or schemes that she has announced are going to be executed, including exact numbers and within how much time, etc. So that's a significant departure in the budget making process itself.
All right, Bodhi, I want to come to you once again. And, we were discussing earlier before the FM speech as to whether or not, rating agencies will dole out an upgrade if the government really, reduces the, FY25 deficit target, which it has done and higher than expectations as well, 4.9%. Do you see a case for a rating upgrade by S&P at least, because it had revised its outlook upwards, right, to positive from stable? So, any chances now that the government has reduced it to below 5% for FY25, we could perhaps see some bit of, upgrade coming in from one of the rating agencies?
Yeah, I don't know whether we have the data. I think bonds have rallied since the budget announcement and the fiscal deficit, but we can check that. But I don't think no upgrade will happen immediately, because they have their own time frames. But I think, but if you in its sort of detailed analysis, when it announced the change in outlook, S&P did say that, I mean, there was a number of things, but I think obviously sticking to fiscal deficit targets was a major part of it. So to that extent, when they it increases the possibility of an upgrade, but I don't think it's going to happen immediately. It will. I mean, it would probably might. I mean, they work according to their own time frames. There'll be no immediate. They'll have to also see where this actual 4.9% target is actually met. At the end of this fiscal. But yes, it is it's positive in terms of a ratings upgrade is concerned.
Okay, just want to take a look at how the market is faring. ITC, of course, continues to be the top gainer. I think there has been no changes to tobacco taxation. Just we'll just confirm that in a bit. But aside of that, if you look at the market, the Nifty has pared some of its losses. 140 points lower for the Nifty, and the Sensex as well. Off days lows down by somewhere around 460 points or thereabouts. At one point of time, we saw a 600 to 700 point cut coming in once the FM announced the changes to the capital gains tax. But right now, holding out, and consumption, of course, doing well. But what about the measures that were announced to boost rural India? There were quite a few of them. Anything that stood out that could actually revive fortunes of some of these FMCG names that have been grappling with low demand in terms of demand, or boosting rural demand? Do you think that the budget has done a fair bit, Bodhi?
I think it has. I mean, there's been no direct handouts. I mean, there's been no this thing, but I think the emphasis of the NDA government has been, to boost rural infrastructure, and that seems to be the message of this budget also. There really hasn't been anything in terms of, uh, in terms of direct or an enhancement of direct income support, by way of what we call handouts, but there's a general attempt to boost rural infrastructure and to support job creation. I mean, there's a whole budget is about a large part of the budget is about job creation. There are there are employment linked incentives which have been announced in the budget. So to that extent, it'll, I think, a large part of this budget, a large big emphasis in this budget is on boosting consumption at the bottom of the pyramid. For the lower income sections of the population, and to that extent, I think it'll help FMCG's stocks.
Hmm. In terms of energy security as well, that's one of the focus areas that the FM highlighted. Nuclear power plant, critical mineral mission. In terms of embracing green energy, uh, how do you really expect the measures to pan out going forward?
So there's the
Gaurav, I'll come to you for that.
solar rooftops
Yeah, there is a
which was announced, I think,
yes.
with that's a big one. It was there in the interim budget as well, and it's very ambitious that you sort of, you if you install panels on solar rooftops, you can actually, households can cut down their power consumption, even be net sellers to the grid, and use the excess power to, for their two-wheelers or their four-wheelers. So I think that
Let me ask
scheme is,
them.
is one of the schemes announced in this budget. Once again, it also has significant job creation. This thing, there's also a scheme. If I to I don't quite know what the don't
April
quite
1 will
remember what the
high.
actual
Finance,
number is, but for
finance
pump
bill
storage. So
25.
there is, so renewables is, I mean, this government has been big on renewables, and there are measures to support renewables. Also, a nuclear power. That's also,
What is written in the
there
finance
was a
bill
lot of
effect from?
references to nuclear power in this.
Then it's a prospective thing. No? Not be applicable. It will not be applicable.
Uh, okay, all right. Bodhi, also talking about the overall, economy standpoint and
Yeah.
what they've done and announced a host of measures. They've kept the capex unchanged. They've paid the fiscal deficit to 4.9%, largely in line with estimates. But the cut in borrowings,
Hmm.
do you think was it lower than expected?
It is a little lower than expected.
And does that, or could that have any impact in on the big picture or for the coming, rest of the year,
No,
remaining 7 months?
it all sort of feeds into what we've been earlier, been discussing in terms of the impact on the bond markets, in terms of what the rating agencies think, the fiscal deficit. So yeah, it is a. I mean, see I mean, you can't really fault the fiscal management part of the way the government has managed the economy since COVID. Their overall macro management of the fiscal numbers, they've been very prudent. I mean, that's really been excellent in conjunction with the RBI. The issue facing the economy, the challenge which the polity is facing, is weak job creation. Um, they've tried to address that to the best of their ability. What will actually happen on the ground, we'll see. But there are lots of measures to support job creation.
And also the medium-term fiscal consolidation paths that they
That's
have
right, yeah.
sort of taken. Will it give them enough flexibility to, chart an appropriate fiscal course?
No, so the plan is to bring down the fiscal deficit to 3%, which is the ultimate. So obviously next fiscal 25-26 it's supposed to be 4.5, and then to gradually bring it down to 3% in terms of the FRBM. So subject to no major external shocks, that should be possible, and that will be positive for bond markets, positive for markets overall. So yeah, but that would, so when you say flexibility, well, it would limit flexibility to some extent if they want to spend money on, if they want to give direct income support to a large section of the population, to the farming community, which this budget doesn't do. They obviously can't do that. But the government, but I don't think this government, the BJP-led NDA government, does not appear to be ideologically inclined to take such those kind of measures. So yes, it does limit their flexibility somewhat in terms of providing direct, in more expansive welfare measures beyond. I mean, there are big welfare measures already, right? There's the Pradhan Mantri Garib Kalyan Yojana. There's the free housing scheme, the rural housing scheme, and the urban housing scheme, and there are all kinds of other schemes. I mean, there are the old schemes like the Swachh Bharat and so on and so forth, which I presume are funded. But I don't see any big, what we would call handouts type of gestures in terms of large direct payments.
So the populist,
The populist, yeah. I mean, whatever populism is there, but I don't think there'll be any further this thing, and that seems to be the measure. So if you listen to the first part of the speech, there were lots of announcements on job creation and the the various schemes for skilling the youth and all that. But ultimately, it's all done within a parameter where they have stuck.
And much of it also depends on cooperation from the private
from the private sector and from
domain.
the states. From the states, there's a lot of also state. It's done in conjunction with the states and with the private sector. So the fulfillment of the budget's vision to a large extent depends on the private sector and the government and the states working together.
Okay. So we have Rahul Arora joining us from the Mumbai studio. Rahul, good afternoon.
Good afternoon.
So worst fears of the market come true, or is market already shrugging off? Do you look at it as a slightly bad news that the market is already shrugging off?
Well, I think it was a bit of a knee-jerk reaction. I think the markets are certainly off from the day's lows. It is definitely a negative for the market. There's no question about that. I mean, it doesn't change too much in the scheme of things from a revenue perspective for the government of India, because I think if you look at the mathematics, this would probably add about 20 or 1,000 crores of revenue to them on an otherwise estimated revenue of almost about 32 lakh crores. So, this isn't even 10% or 5% of that number that you're talking about. But yeah, of course, sentimentally, both on the futures and options as well as on the cash market, you've sort of made these changes. But the interesting part, of course, is that the exemption limit has been raised from 1 to about 1.25. So they've offset a little bit of this increase through the exemption of that 25,000 that they've given. But I think the market will absorb this in the larger scheme of things. See, nobody likes an increase in tax, but obviously, is this increase that significant that it is going to deter equity market investments? I don't think so. There are a lot of things in this market that are other asset class positive. I'm sure you've discussed gold and what's happened with the duties there. The fact that the borrowing program is in line and the fiscal deficit has been projected at 20 basis points lower than what the market was expecting, that could also land up being bond market positive. So it actually opens up other avenues for investment as well. But yeah, I think prima facie hiking the rates is negative. But I think the way the market is reacted from the day's low is telling you that people are ready to buy into these dips.
Sure. Obviously, this is a very strong bull market. So even on election day, we could shrug off an adverse outcome on March ahead. So this is not something that is not digestible for the market. We also have with us Shankar Sharma joining us. Good afternoon, Shankar.
Good afternoon.
What's your takeaway? Big takeaway. Status quo.
I'm not happy.
Sorry?
Not happy.
I'm not
Not happy about what?
I mean, we don't have an increase in the capex budget. We don't, and we have an increase in my tax budget. So I'm not happy. As simple as that. I don't think it was required, this kind of sort of tweaking that India, I mean, I love the word tweaking, that it's not tweaking. I mean, a 20% increase in tax for long term and like a third increase in short term is significant tax increases. And people are talking. I was on another channel and they were talking about, somebody was talking about this exemption limit being raised from 1 lakh to 1,25,000. I mean, that's a palliative. That's like nothing at all. I don't see the purpose of doing all these things. I can understand that on FNO you do want to curb some degree of speculation and all that, but for equity market investors, just because they've had 3 good years, prior to that 6 years of this government delivered risk-adjusted lower than fixed deposit returns, which was 2014 till 2020 March. And in the interim, there was a very bad, actually not even captured by the index levels, a very bad period of 2018-19 and up until the March of 2020, which was following the imposition of long-term capital gains tax from 0 to 10%. Despite the fact that it had been removed and replaced by STT. So STT remained and then LTCG was also imposed. And that sent the market into a tailspin. And I must point out this to you, and this is very important. Everybody thinks India has some great market. I'll give you the data. 2019, the year following the imposition of the LTCG, India was the 18th worst performing market in the world. 18th. Okay. Europe was up 25%. S&P was up 28%. Nasdaq was 35%. Most of Asia was up like, around 18-25%. India was up only some 6-7%, something like that. So that is the effect that an imposition of taxation had on the stock market. So I hope it does not repeat it. I'm invested almost 100%. I hope those days are not revisited. But this was not required. This was not necessary. That's my unequivocal point of view.
Shankar, nobody likes tax raises. But tell me, this 2.5% hike, will it change the complexion of equities or the attractiveness that equity poses to Indian investors now? Because that is the large cohort that is really, that we rely on. We're not relying so much on, FII flows anymore. Does this change that equation?
By that, then why 2.5%? Why not 1%?
No,
why
I agree. I agree.
Why not 4%? Why not 5% more? I mean, what are these percentages about? That way, from a base of 10, everything will look only ke 2% to bada hai yaar. Arre bhai, it's a 25% increase, and on STCG it's a 33% increase. That is like if your personal income tax is 30% tax slab, it has gone to 40%. Is that small?
No, STCG is definitely.
Would you be happy if you, as a householder, your tax bill went from 30% to 40%, which is effectively on the equivalent blended basis what we have been given in this budget on the capital gains side? How is that insignificant? I don't understand.
No. I'm not saying it is insignificant. I'm just making a distinction between this long-term and short-term here, Shankar. Long-term, my pointed question is, does this change the attractiveness of equities at all? My limited question is that. I'm not disputing whether it is good or bad, because we have to look ahead, right? I mean, I'm not sure whether the finance minister is going to revisit this change. So this is a given now. But going forward, what does it mean for flows? What does it mean for people who are looking at equities? And today you look at whether it is the retail investor or the HNI or big, large family offices, promoters, all the money that is going out of stock markets is also coming back to stock markets in one way or the other. So does this change that equation? Should we worry?
Look, it's too early to say that. Okay, we cannot say for sure. The larger point here actually is that markets have run up a lot. When markets run up a lot, then they look for reasons and excuses to correct. Okay, we had a similar period post demonetization when the markets ran up a lot, and then the LTCG came and that crashed the market for next 2 years. I hope that, again, I'm saying, I'm invested. I hope it doesn't repeat. But I fear that some element of that might actually come true, because markets have rallied a lot. At this point, incremental good news doesn't do much good, but incremental bad news can have a disproportionate effect. That's my real fear. I don't have a clear answer as to whether this will break the camel's back or not. I hope it doesn't, but I'm just saying we could have done without it. It is just an unnecessary sentiment spoiler. And the sentiment was amazing in India. Why do we need to do all these things when things are going so well?
Also, Shankar, this whole idea of increasing short term from 15 to 20%, and also tinkering with STT, it seems to be some sort of a concerted attempt by the government now. SEBI is also looking at taking a lot of measures. The margins are already high, but also taking the lot sizes higher to essentially rein down, take away some part of this exuberance, or cool off this speculation, right? Also an attempt to cool off the market. The question is...
Let me be very clear. Let me be very clear about it. What market are we talking about here? Are we talking the FNO market? Are we talking equity markets? If you're talking FNO markets, this STCG from 15 to 20 doesn't matter. That's not where we are supposed to pay all these things. That's the place where all your tinkerings on margin and STTs will have an impact and should have an impact. But when it comes to equity market investing, and I'm only limitedly focused on the equity part of it, not the derivatives part of it, I'm saying that a 15 to 20% increase is significant. And I don't see why somebody should be penalized so heavily merely because he bought something in January and sold something in November. I mean, I just don't get the logic. See, every taxation has to have some logic. I don't understand what is the logic of doing these things. It's not enough to just brush it aside and say that it's not that big a deal. It is a big deal because we need logical explanations for these things, and I don't see any.
Cool. Anything else that you took away in terms of a number of schemes that she talked about, most of it related to employment, rural? Those were mainly the talking points. Apart from that, like you rightly pointed out, capex growth, the market would have definitely liked a little more, but she has been saying for a while that, and also the economic survey also pointed out that now it's time for private sector to actually step in. So anything else that you took away?
That is the point, that capex, I've been very unequivocal about it again in the last couple of years, year and a half, that it cannot increase because the government has increased fiscal deficit like crazy. We were normalized 3.5% over the last 20-25 years, and suddenly we went to 10% post-COVID, and that has been gradually brought down to 5.5, 6%. But that is still huge by any standard. The government cannot run deficits of this kind. We'll get into a debt trap. So the government has to ratchet that down gradually to, they talk about 4.5, I think that's still too high. More like 3.5 is more appropriate. In order to do that, it can only cut back on capex. So this 11 lakh crores, I'm pretty sure, forget about rising, it may even come down in the next budget because it cannot remain at these levels. So I have factored that into my numbers, which is why I've not bought the railways and the defenses that people have been gaga about. The fact is that every sector which has derived benefit from government capex will be hit, and I'm not thankfully invested in any of those sectors because that trade is not going to work in the future. Government capex has hit a ceiling; it can only come down from here; it cannot go up.
So that's a substantial pivot, isn't it, from the market perspective?
Yes.
So where are the new bets? Where do you see the leaders of the new?
I don't see anything positive in this budget that should give me incremental reason to be bullish because of the budget itself. There might be some other reasons extraneous to the budget, but the budget is a fly in the ointment. It is not creating a positive environment incrementally for equity investing.
Okay. So obviously this, the bond market seemed to be quite happy with this fiscal consolidation happening. I mean, nobody was counting in 4.8 4.9% for this fiscal. I mean, she could have kept it at 5.1% and given us a little more by way of capex. Would you have preferred that? Or should we care about fiscal consolidation at a faster pace? Because some of the money that you're getting is also one-off, right? The 1.3 lakh crore that we talked about in RBI dividends, excess cash, that is also a one-off item which will not come back next year. Therefore, it's better to sort of be on that consolidation path quickly than to continue to do the heavy lifting on capex. I'm just playing devil's advocate to elicit to see if there is a different response.
No. I mean, look. I'm very clear in my head. Every government likes a bull market by and large. Okay, and the way to create a bull market are primarily two. I'm talking from the government standpoint. Basically, run very loose fiscal deficit, which we have, and to run very low interest rates, which we have also kind of kept reasonably low, given the fact that real inflation is quite high. We probably are running at 0% real interest rates right now, which is extremely low. If we have these two recipes, we'll have a bull market, and that's exactly what we have had. But the government and the RBI also, they recognize that this cannot continue like this. We need to ratchet it down. So if I were sitting in the position of decision making, I would definitely not increase the fiscal deficit. I would cut back. And you're right that some of the gains are, or some of the revenues are one-off. I would rather use that like a asset sale for a company or a household. This thing, you've sold some, property here and there. Use that to pay down debt or reduce your cash outflows or the negative gap in your cash flow, rather than use that for consumption or for spending or capex or whatever you want to call it. I think that's prudent. All I'm saying is that's not good news for stock market, because stock markets don't care about fiscal prudence. Let me be absolutely categorical about it. Give us a party. As long as you are paying the bills, we're happy to get drunk. Don't ask us for the bill. And if the bill comes, as long as we are not in the bar at that point in time, the next guys are paying, we are also fine with that. That's how bull markets happen.
Fair enough. In 2 minutes, just quickly tell me, what is your strategy from here on? Where do you focus?
Good question. So actually, I didn't watch much of the budget. I mean, I was in a company. I'm in the company's office having a meeting. So I'm still doing what I will do, which is to go and find interesting companies, hopefully make some money out of it, and hopefully not cry too much about the incremental tax. But I am crying right now. You can't see my tears, but they are there.
That's a very broad statement. Tell me specifically any particular segments, at least three segments that you're really bullish on.
I remain a small cap bull.
And since you're bearish, some shorting opportunities.
Shorting?
I'm saying since you're bearish, some shorting opportunities also.
I don't think you are in a shorting market. I don't think you can short it. You can. I mean, by the way, I have sold a fair bit. I've been sitting on cash in the last few days, running up to the budget. So hopefully we'll see when the dust settles down whether I can find some places to put cash into. So yes, thankfully I did take some money off the table.
Sure. Thank you so much, Shankar, for joining me this afternoon.
Thank you, Mahalakshmi. As always, real pleasure. Thank you.
Okay, we have with us Rashesh Shah, founder and CEO at Edelweiss, joining us now. Rashesh, good afternoon. Your first thoughts on the budget?
Hi, good to see you. And yeah, I think there is quite a bit of excitement. I think every year this happens.
So, but is this exciting at all? The fact that we have a hike in the long-term capital gains tax, short-term buyback tax, which I think you should care about. A lot of people in the stock markets have to care about, all companies, because every buyback is the new dividend, right?
Yeah, I think buyback and dividend had a gap in that, so that gap had to be equalized, because ultimately both are the same thing. I mean, whether you buy back or you pay dividend.
Tax-free dividend is buyback, yeah.
Yeah, so I think that equalization was expected. Though, I mean, there is a school of thought. A lot of people believe that you should not have either buyback or dividend, because the company has already paid the tax. So this is already after tax money. But that's a ideological debate. I think government has a hard task there to really pull out money wherever they can. And we should always remember that capital market is still a very small part of India's investing base. I mean, it's grown a lot in the last few years. So I personally think the STCG, the LTCG increase from 10 to 12.5, is all okay. I think the markets have made enough returns, and the markets, see, the market even now on an after-tax basis over 30 years has given a 13-14% kind of a return. So if there is a little bit of increase in tax, I think the market will absorb it. I think the larger returns in the market will not come from changes in long-term capital gains or buyback tax and all, because dividend income is a very small part of an investor's return. A large part is capital gains, which comes out of growth. So I think the larger issue is, will this budget restore profit earnings growth for Indian companies, and overall that will give a much larger return to investors. So I personally over the years have seen that tax is excitement for a few days, but the markets adjust for that. But what is really important is, will this budget lead to higher growth?
On that vital question, Rashesh, what's your take? Does the budget really have things to ensure sustaining earnings growth of the past 3 years?
So I think last 3 years, obviously we came out of COVID and there were all those other extraordinary factors. I personally think to get growth to move, private capex and interest rates will have to come down. I think private capex will have to go up and interest rates will have to come down. Because I don't see exports as being a leading driver of growth in India, though we have this China plus one and all going on. But I think the global markets are becoming more and more protectionist. If there is a Republican government in the US, I think exports to US will get even harder. So we have to get our local growth done, which will come from the government has been driving a large part of the capex, and I think that has done well. In fact, the growth rate, the GDP growth we're seeing now is mainly because of government spending on capex. But unless we get private capex out there, and unless we get interest rates down, I do think that, I think if I see the numbers, they are projecting a nominal 10.5% growth. And if I take a 4% inflation also, then it is a real growth of only 6.5, which is slightly disappointing. I hope India aims for at least between 7 to 7.5% real growth for this year.
But that might just be conservatism, Rashesh, because last 3 years post-pandemic, you've seen that the budget estimates were always underestimated. You always had a better figure in the revised estimates. The tax collections always were better than what was projected. So in that sense, this 10.5% may end up at 11%. That's one thing. But coming back to the point on private investments, what is stopping corporates from investing? Because before the elections, of course, last year, we were saying that the capacity utilization levels were still at 70%, 75%. So there was more room for companies to, exhaust their existing capacities to move on to do fresh capex. Then you and I had this conversation. You were saying that brownfield expansion is a far better way to do it than greenfield. That was one reason that was holding up. Then election was the new reason. Now we are running out of reasons to defend why private capex is not taking off in a big way.
I think as you very correctly said, I think when I talk to companies, and ultimately there is no one easy answer to that. We only talk to companies and find out why companies are not investing as aggressively as they've been doing maybe 8-10 years ago. I think there are 2 or 3 reasons that I see. One is obviously demand is slow, consumption is slow. So if you see, capacity utilization has not gone up, and we need to be consistently at about 74, 75, at which point companies will start adding to capex, anticipating future demand. So I think the current demand is not as robust as we would want it to be, and the expectation of future demand is also not very strong. And actually that is the real conundrum we need to crack. And I was hoping that the government cracks that problem, that how do we revive actual demand and confidence on future demand, and that is still not there. I mean, even when we speak to companies, it's slow. Demand is not there, which is not giving companies the the confidence to invest. The other times companies invest is what we call they invest ahead of the curve. That even if the demand is not there, they make the investment because they expect the demand to come there. And in India, that has also happened in the past. where there were animal spirits out there, people were willing to take risks and all. Right now, I think amongst corporates, risk taking is only limited to what I can do with my equity. But nobody wants to take any risk with borrowed money. So project finance, putting up a new steel plant or a cement plant or a power plant, people don't want to borrow money. And that also, the hesitation to put project finance, which is with borrowed money, is also affecting growth of new capex. So I think this two angle, one is more confidence on the future demand as well as not willing to take risk on borrowing money and putting it. And you can't put up capex only with equity. For capex, you need both equity and debt. And with the bond markets not being as robust, with the banks also willing to fund a lot of working capital, but project finance is still a very risky area. So I think those are the ones that we need to solve for. There are some good news on that. The new infrastructure bank is doing quite a bit of work. I think they have very exciting growth plans on infrastructure funding. So infrastructure should happen. But again, a lot of that will be government led and PSU led. We need to see more private sector investing in infrastructure and capex and all, for which they have maybe a little bit of equity and they can raise equity. Equity markets are very good, but they are very hesitant to borrow money for that.
So why is that this hesitation to borrow? Is it just scarred by past experiences, or what is it?
Yeah, it's scarred by past experiences, and I think NPAs and all have been very big. NPA is not an accounting issue for us. NPA is a very emotional, psychological issue for Indians. I think in stock market you can have an IPO of a company that comes at 1,000 rupees and the stock goes to 500 rupees. It's okay. In if you take a loan or a bond and if there is a credit event, it becomes a very scarring issue. And I think that is the risk aversion for the debt market, and that is also partly holding back the capex. At least I know a lot of companies who are very, very cash rich, lot of free operating cash flow, but they are saying, you know what, we don't want to borrow money and put up a new project and don't want to take the risk. If the cycle goes against us and we become an NPA, we end up losing everything. So they would rather not take the risk and just be on status quo rather than try to put up capacity ahead of the curve. Now, will they put capacity after the curve? Absolutely. When the demand is clear, people will take risk. I think we now need people to take risk before the demand is clear, and that is where the hesitation is very clear.
And what do you think is the capacity utilization right now in traditional industries?
I think we are between 70 to 74, 75. We have not crossed above 75.
Right.
And actually many, it varies from industry to industry. I think under 70 is bad. Between 70 75, you are adequately capacitized. In older India, maybe a 10 to 15-year India, between 70 to 75 is where people will start, taking risk. But
Right.
I think right now maybe people will start taking risk once we cross 80% capacity utilization.
Right. Um, One more question, Rashesh. There was one announcement that the FM made related to, PSU banks essentially putting some technology in place, doing some digital, essentially tracking digital footprints and creating credit scores for MSMEs and stuff like that. Do you think that'll alter the equation in a way that that's right now in the realm of all the digital players, microfinance companies, agile nimble footed companies? What does this do to that landscape? Do you see this as a threat, or is this something that PSU banks can do and take away a large proportion of that market? How do you see this pan out?
I haven't understood this part as much because I've not read the fine print, but the way you have explained it, I would think it will make a lot of sense because ultimately all credit is about information processing. So
Right.
not only the new digital fintech players, but we have also had credit rating agencies and credit bureaus, because for MSME, the individual credit score of the promoter as well as the credit rating of the business are also very interlinked. So I think a lot of information is out there, a lot of data is out there. I think data processing is still behind the curve. So there is still a large part of MSME market which is underserved, which means they are eligible for credit but not getting enough credit, given the kind of business they have. So if this data helps in processing that information more efficiently and making credit more widely available, I don't think this will be used to say you can't give credit to MSME. I think it will be used to say which are the MSMEs who should get credit, who are not getting credit now. And if that happens, it will be good. I think not only banks, I think everybody, NBFCs, everybody will have to use data for credit evaluation rather than what old world has been, which is go and do a physical examination, have a personal meeting. More and more for MSME, if you rely on data, there'll be much more efficient credit delivery to MSME. I would agree with that.
No, I'm just asking only because, this might take, at least the moat around some of those digital companies. If this also becomes digital public infrastructure of sorts, then the moat around some of those companies may just be lost.
And actually,
So in that
Mahalakshmi,
sense,
that is true with almost everything. I think as data and data processing becomes more and more commonplace, I think any data based moat you have will ultimately go away. A lot of others will depend on customer experience, on your distribution prowess. All that will still be there because banks already have distribution prowess in any case. So I would think anything that is data based with AI coming in and all that, a lot of that will anyway get commoditized. Like we have seen UPI came in, I think entire the payment infrastructure became more and more commoditized in India because that has to be the way it is. So if it becomes part of PDI, that MSME data processing, I think that will make credit more efficient. But you can't build a moat only because you are better at getting information and processing it, because everybody catches up on that. That's a new way of the world.
Rashesh, one final question. Are you feeling more bullish about your own business after this budget? You have, all pieces of the pie, at least in the financial space. Do you feel more bullish?
I think I'm very confident. I think India, we will get, as I said, a real growth of 7 to 7.5 is what I'm hoping for in this year. I think at 7.5 will be one of the fastest growing economies in the world, and we are now a $4 trillion economy. So I think I'm confident given the budget, the government finances also in a good place. As I said, there are still issues of private capex and demand and all that. But I think overall, I found the budget pretty reassuring on India's growth story. So I'm happy with that because all of us are highly correlated to India's growth story.
All right. Thank you so much, Rashesh, for joining this afternoon.
Thank you, Mahalakshmi. Bye.
Bye.
Okay, well, how are the markets doing? If we could just pull up and see if there's been any recovery, because after the initial shock of 250 odd points, okay, right now, still hovering around the day's low, mild recovery has been there. It's 180 points shaved off the Nifty right now. 24,330 is where we're perched at. So slowly recovering. But, Mahalakshmi, you've already spoken to a couple of them already, market experts, market watchers. Some seem to be very, very upset with the LTCG division, even STCG for that matter. But overall, how do you think? I mean, market also still seems to be like undecided, assessing the fine print perhaps, but barring the taxation bit, uh, what do you think, has been the overall sense right now?
I think markets, we are in a bull market, we have to admit that. So a lot of negative news gets shrugged off. And that is why I think this tax thing also has been shrugged off. But I think as Rashesh was pointing out, he didn't say that, but my own feeling is that a lot of stuff that we heard, because we haven't seen the fine print, a lot of it was around employment, youth, rural spending, and all of that. And we didn't see very concrete measures to see to tell us that consumption will be clearly on a growth path, which is one thing that was that's missing. And secondly, any hopes of any hike in the capex also did not come through. So I think those two things were a bit disappointing. But be that as it may, we have Sushil Kedia joining us. Good afternoon, Sushil.
Good afternoon.
More bullish or bearish after the budget?
Bullish on India, bearish on markets.
Okay, explain.
Bullish on India is obviously a longer term story. And in the short run, markets had already started selling off. They had come down in the last 3-4 days only with a hesitation. Should the budget not come and spoil the bear's game? Globally, a sell-off has started already 8-9 days ago. Nasdaq, S&P made their tops way ahead of us. Nifty was reluctant. Bank Nifty, as it is, made its trading top 8-9 sessions ago. It was a soft decline. And now that the budget has left nothing for the bulls to owe, I think the short-term game today that everybody sold off the moment long-term and short-term capital gains and STT were touched, that, the extreme short selling that has happened, short squeeze for the day has worked out. But I think Indian stock markets are now having no reasons to not join the global correction that has set in.
Any hiding spaces you see?
See, FMCG has continued to be positive through the day. We spoke before the election and, ahead of the budget also. We've continuously maintained those bets on IT and FMCG. So mid-cap ITs are still places to hide for going forward. FMCG stocks will still hold on, even if, the others are selling off, metals and autos are selling off. And maybe, we'll also carry on with our 6-month bet on chemicals. So everything is not a sell. Nifty and Bank Nifty indeed are, but there are pockets. There are definitely not only places to hide, but also do well as an investor or alongside a trader.
Karunya?
Okay, all right. Just wanted to also understand, after reading the memorandum, while LTCG on the listed shares, has been upped to 12.5%. It has been brought down from 20% with indexation to 12.5% for other assets, including property. So if you could, explain this for the benefit of our viewers, what exactly?
Audio has been poor, so I really hope you don't mind putting your question out to me again.
Sure. I'm just saying that while LTCG on listed shares has been upped to 12.5%, it has been brought down to 20% with indexation to 12.5% for other assets, including property. So if you could tell our viewers, or rather explain to our viewers how this would work out.
Okay, so see, I'll tell you what. When do rentals go up? Landlords come and ask for higher rentals when people are earning more and they can afford more. When do interest rates go up? Bankers will come and ask for higher interest rates when economy is heating up. So if the government has increased the rent for investing and trading, government is the owner of the stock market, say as a ideology or kind of, take that as a parallelism. So taxability is going to be better, and that's why government is taxing the stock market more than it has taxed in the past. Should not become a reason for worry for investors. Buying at the tax, and as it is the second most subsidized business to be an investor. Farmers don't pay income taxes, and stock market investors pay the lowest tax. So if record amounts of money are being made, and justifications were laid out by SEBI, RBI, and the economic survey that there's too much speculation going on. So those are justifications. The fact is, people are minting money on the markets, and government wants a better share of it. And at the same time, to not saturate household savings only into what might turn out to be a speculative bubble eventually, to facilitate diversification, if through indexation benefits means, say you bought something in 5 years ago at 100 rupees. Inflation would have brought the value of that without any benefits to you, to say at the rate of 10%, approximately 50% 5 साल में inflation अगर हो गया, it's compounded. So if it becomes 150 rupees, you have not benefit at all. So with the benefit of indexation, if post-inflation adjustment, whatever the indexation values government fixes, if the tax rate has been adjusted down, so government is encouraging the diversify beyond stock market. Stock market should not be your only place. Diversify your basket. Don't put all your eggs in one basket of the stock market. So I find it very prudent and sensible. Any good, clever businessman should increase prices where demand is more. If stock market is where capital is rushing in and they are doing very well, government taking a little extra pound of its flesh is absolutely fine.
Right, Mr. Kedia, Nandita here. You said you're bearish on the markets, but there may be some pockets that you're bullish on, right? Especially the consumption pact, the FMCG pocket. On election verdict day as well, we saw FMCG come to the rescue, and today as well, markets are under pressure. But the Nifty FMCG index is holding fine, and ITC in particular, up somewhere around 4% or thereabouts. There's been no change in tobacco taxation. And of course, there have been quite a few measures that have been announced to boost rural infrastructure. So, in that sense, would you be bullish on the FMCG pack? And if yes, which are the stocks that would excite you now? Mr. Kedia, sure. Mr. Kedia, could you hear me? All right, I think my voice is not reaching him. But ML, coming to you, I think we've had chats with a lot of in-house editors, but I haven't really been able to get in your take on which are the pockets that investors or market participants are really betting on after the budget. Because as I was pointing out to Sushil as well, that consumption is one pocket that has come to the rescue today as well, and on the election verdict day as well, when we were anchoring together, we saw how the FMCG pack was buzzing today as well. The main point being the kind of measures that have been announced to boost rural infrastructure. And secondly, no changes to tobacco taxation. And that has come as a boost for ITC, that's up somewhere on 4% or thereabouts. So is consumption really a pocket that the market is looking at the current juncture? You've already had a few chats with some big market voices. Any sense you're getting?
So Nandita, when the rest of the market is quiet, FMCG takes a step forward. That's about it. Although having said that, I mean, there might be some fresh triggers for consumption stocks to do well now. First of all, over the last 2-3 years, valuations have gotten a little more. These stocks have become slightly, I can't say cheaper, but less expensive compared to the rest of the pack. That is because one, earnings have grown for all these companies, but the markets have not. The stock prices have not grown as much. Secondly, the rest of the pack, which the entire industrial pack, banks, all of them have gone up more sharply, and therefore they look a little more. Those valuations don't look as stretched as they looked about 3 years ago. So that's really a trade-off. But the fact is that like somebody, I think one of the guests in the morning was also saying that till you don't see a slowdown in order book positions or growth numbers of some of these companies which have been in momentum, whether it is real estate or PSU banks or not railway stocks but defense stocks, all of these which have been in momentum, unless you see some fundamental trigger for a slowdown, those stocks will continue to march forward. I don't particularly see any fresh triggers for consumption, although at the margin they could be gainers. The best pack in the entire market continues to be banks, because those banks seem to be a relatively undervalued pocket, and that's a fairly significant part of the market. Nearly 35% of Nifty is banks. So that is one hunting ground that people may want to consider.
ML, if I may, I think you were, before the budget, I talked about despite the market missing the opportunities to bring about a correction. But I think Mr. Kedia was also, I think, reflecting that point when he said that now there is no reason for India not to join the global correction. I think that is because, I mean, he's in the context of the capital gains tax. But we'll see. I think we are in a bull market. It's possible the markets might bounce back strongly tomorrow or this thing.
One of the things about markets is, bull markets climb a wall of worry, they say, right? So as long as there are worries, and as long as we are talking about concerns around valuations, and everyone, including the regulator, is very, very vigilant, I think the markets will continue to move forward. Except that...
I think if you saw Nitin Kamat's tweet, I think he is also talking about attempts to bring down the market, and says this might do it. But I think the regulators have been worried about the levels of the market. I think there's a concerted attempt underway. Whether it's succeed or not, you want to talk about, I think there are some points we're getting, some fine print we're getting on indexation, etc. do we have enough to talk on that?
Not really. I
Not
mean, it's
at
just
this point. I'm just trying to also. Maybe we'll
no,
come
I'm
to
not
that
really,
later.
very clear about what exactly is there, whether it is prospective or whether it is with indexation, without indexation. What is the deal with property versus stock? I'm not very clear about it.
I think we'll have to look at the
We'll
fine
have to
print.
wait to see the fine print and get an expert to decode this, which we will do in our personal finance show after market hours, or if we get an update sooner than that. Um, Nandita, a quick market check will be in order.
Yeah, sure. But I just want to point out, I was just reading the budget fine print. Just to answer Bodhi's question, indexation on long-term capital gains for property has been removed, and indexation on long-term gains for gold and other unlisted assets, has also been removed. Bodhi, if you want to give your take on this, we could come to
No, sorry,
you
just
so
come
that
again.
you
Indexation
could
has been removed for shares and mutual funds. Is that what you said?
property as well as gold and other unlisted assets.
Has been removed. And what is the rate for property and unlisted assets? What is the taxation rate?
I need to look up on that. But for now, the budget fine print says that the indexation on long-term capital gains for these asset classes has been removed.
No, so
But on
I
that note, we'll
don't
come
want.
back and we'll
Yeah, let's just
Sure.
understand what exactly it means instead of giving a random reaction.
All right. Taking a look at the markets, then we have come off from the day's low. The Nifty is down, 120 points or thereabouts. We were, looking at taking out 24,000 at one point in time when the changes to, taxation or capital gains tax were being announced. But we have, really managed to stage a good recovery, although it's a 116-point cut on the Nifty right now. Sensex also down somewhere around 350 points. The mid and small cap end of the markets are looking at deeper cuts. So a 1.2% or over 1% cut coming in on the mid and small cap indices. And if you look at the market breadth, the advanced decline ratio on the NSE is almost 1:3. So yes, the broader end of the markets are under pressure. Of course, it's the consumption names, that is providing support to the index. So of course, you had the customs duty cut on gold as well, and Titan is clearly reacting to that. 6% up for that. ITC, no change in tobacco taxation, so that's up somewhere around 4%. All the other names like Tata Consumer, HUL from the FMCG pack are among the other gainers. What else is doing well is the likes of TCS, Adani Ports, Dr. Reddy's, Infosys, HCL Tech. So IT stocks are once again doing well. Defensives are doing well, so to say. On the other hand, you've had some of these PSU stocks that are under pressure. ONGC, you have Power Grid, Coal India, and PSU banking names like SBI under pressure. Also some private banking names like Axis Bank is under pressure. But I want to point out that fertilizer stocks have taken it on the chin. Fertilizer stocks, which have been rallying quite a bit in the run up to the budget, have seen deep cuts, and so have the railway stocks. Of course, the government has maintained its capex figure of 11.11 lakh crore rupees. So no changes there. There were perhaps expectations building of the government, kind of upping their capex for FY25, but that hasn't happened, and we are seeing that disappointment play out on some of these names. But ML, aside of that, if we have our next guest or if we have Sushil, we could ask him about how one should really navigate, some of these railways and defense stocks post the budget.
Seems we don't have Sushil, but we do have Prashant Jain. Prashant, good afternoon.
Good afternoon, Mahalakshmi.
What is the big takeaway from the budget? Where are you placing your next bets?
Mahalakshmi, I think it's a very good budget, and I don't see any negatives. The policy direction is consistent. Invest more, improve the ease of doing business conditions, maintain stability and taxation, direct indirect taxes, and bring in more equitable tax regime. And I think some concessions for the low income groups and higher taxation for the HNIs, ultra HNIs, by way of taxing higher taxes on capital gains and on buybacks, and maintain that, accelerate fiscal consolidation which I think is great. And government has done its bit of supporting capex. And I think by creating, uh, reducing fiscal deficit, they will make it easier for the private sector to step in. And I think net net, and I don't feel there is anything to be concerned about at all.
Were you disappointed about capex number remaining the same? Because even after the interim budget, most people were speculating that, it was only a 17% rise over the previous revised estimate, and we could have done with a 20-25% because the signs of private capex coming on stream is still not very clear.
Actually, to be honest, I was not disappointed at all, because we have to be mindful that 3 years back or thereabouts, the capex to GDP was about 1.7%. You have taken it up to 3.4%. So I think there are limits to how high that number can grow. In fact, we have written in our last quarterly that we believe fiscal consolidation should progress. And one of the reasons is that government's capex to GDP is unlikely to go up in percentage terms. So I don't think I am disappointed on that front. And and after our interim budget and this budget, there is hardly any gap. It is by the same people, the same thought process. So there was no disappointment for me personally.
Okay. Prashant, how do you see the complexion of the market change in terms of, uh, the stocks that have led the rally over the last 2-3 years? Do you see that change? Because largely it was private sector banks, a lot of public sector banks, and a lot of other public sector companies, and you own a lot of them. Do you see momentum shifting away from that pack?
Yes, I
Especially
think,
as you're saying that government spending is not going up, and there are limits to that. Does it also limit growth opportunities for some of those companies? Of course, you
it is
have to.
increasing.
I mean,
Yes,
it's quite a
government
diverse basket, but you can expand on that.
government's capex is going up, but I think it is the rate of change is certainly coming down, and I think that's quite normal and to be expected. And I do feel that the with the sharp run up in prices in the engineering, manufacturing, defense space, the markets are pricing in very high levels of growth for considerable periods. So I think the risk reward in that space is much lower, and I would be either very selective or be cautious on that space. And this applies irrespective of whether you are public sector or private sector. I think markets have moved beyond distinguishing companies or valuing companies on the basis of ownership alone. And today, I don't think companies are cheap or expensive by virtue of being PSUs. So I think uh, I would be cautious in the manufacturing defense space, but banks I think are okay. Banks I think are
But in banks, would you prefer the private sector banks, or is there value in public sector banks? Especially because of
the
this, the whole narrative that deposits are becoming more and more expensive to come by, and do public sector banks have an advantage there?
I think again the markets are not differentiating between public and private sector. If you look at, for example, the valuation gap between State Bank, the biggest public sector bank, and the other large private banks has narrowed considerably. I think some discount is warranted, but it is clearly much lower than what it used to be. So we own strong private banks and strong public banks. I think that's how it should be because the valuation gap has normalized. I don't think public banks would have any uh, special advantage when it
ये
comes
देश के
to deposits.
गांव
But yes, in
गरीब
some
किसान को समृद्धि की राह पर ले जाने वाला बजट है पिछले 10 वर्षों में 25 करोड़ लोग गरीबी से बाहर निकले हैं। ये जो न्यू मिडिल क्लास बना है, ये बजट उनके सशक्तिकरण की निरंतरता का बजट है। इन नौजवानों को अनगिनत नए अवसर देने वाला बजट है। इस बजट से शिक्षा और स्किल को नई स्केल मिलेगी। ये मिडिल क्लास को नई ताकत देने वाला बजट है। ये जनजातीय समाज, दलित, पिछड़ों को सशक्त करने की मजबूत योजनाओं के साथ आया है। इस बजट से महिलाओं की आर्थिक भागीदारी सुनिश्चित करने में मदद मिलेगी। इस बजट से छोटे व्यापारियों, एमएसएमईज को, यानी कि लघु उद्योगों का, उसकी प्रगति का नया रास्ता मिलेगा। बजट में मैन्युफैक्चरिंग पर भी बल है, इंफ्रास्ट्रक्चर पर भी बल है। इससे आर्थिक विकास को नई गति मिलेगी और गति को भी निरंतरता मिलेगी। साथियों, रोजगार और स्वरोजगार के अभूतपूर्व अवसर बढ़, ये हमारी सरकार की पहचान रही है। आज का बजट इसे और सुदृढ़ करता है। देश और दुनिया ने पीएलआई स्कीम की सफलता देखी है। अब इस बजट में सरकार ने एम्प्लॉयमेंट लिंक्ड इंसेंटिव स्कीम की घोषणा की है। करोड़ों नए रोजगार बनेंगे। इस योजना के तहत जीवन में पहली नौकरी पाने वाले युवा की पहली तनख्वाह हमारी सरकार देगी। स्किल डेवलपमेंट और उच्च शिक्षा के लिए मदद हो या फिर 1 करोड़ नौजवानों को इंटर्नशिप की योजना, इससे गांव के, गरीब के मेरे नौजवान साथी, मेरे बेटे बेटी देश की टॉप कंपनियों में काम करेंगे। उनके सामने संभावनाओं के नए द्वार खुलेंगे। हमें हर शहर, हर गांव, हर घर एंटरप्रेन्योर्स बनाना है। इसी उद्देश्य से बिना गारंटी के मुद्रा लोन की लिमिट को 10 लाख से बढ़ाकर 20 लाख रुपए किया गया है। इससे छोटे कारोबारियों, विशेष रूप से महिलाओं, दलित, पिछड़े, आदिवासी परिवारों में स्वरोजगार को बल मिलेगा। साथियों, हम सब लोग मिलकर भारत को ग्लोबल मैन्युफैक्चरिंग हब बनाएंगे। देश का एमएसएमई सेक्टर मध्यम वर्ग से जुड़ा हुआ है। एक प्रकार से एमएसएमई सेक्टर की ओनरशिप मध्यम वर्ग ही है और इसी सेक्टर से गरीबों को ज्यादा से ज्यादा रोजगार भी मिलता है। छोटे उद्योगों की बड़ी ताकत, उस दिशा में हमारा अहम कदम है। इस बजट में एमएसएमईज के लिए ईज ऑफ क्रेडिट बढ़ाने वाली नई योजना का ऐलान किया गया है। मैन्युफैक्चरिंग और एक्सपोर्ट्स इकोसिस्टम को हर जिले तक ले जाने के लिए बजट में अहम घोषणा की गई है। ई कॉमर्स, एक्सपोर्ट हब्स और फूड क्वालिटी टेस्टिंग के लिए 100 यूनिट्स, ऐसे कदमों से वन डिस्ट्रिक्ट वन प्रोडक्ट अभियान को गति मिलेगी। साथियों, ये बजट हमारे स्टार्टअप्स के लिए, इनोवेशन इकोसिस्टम के लिए ढेर सारे नए अवसर लेकर आया है। स्पेस इकोनॉमी को बढ़ावा देने के लिए 1000 करोड़ रुपए का फंड हो, एंजल टैक्स हटाने का फैसला हो, ऐसे कई सारे कदम इस बजट में उठाए गए हैं। साथियों, रिकॉर्ड हाई कैपेक्स इकोनॉमी का एक ड्राइविंग फोर्स बनेगा। 12 नए इंडस्ट्रियल नोड्स, देश में नए सैटेलाइट टाउन्स का विकास और 14 बड़े शहरों के लिए ट्रांजिट प्लान, इससे देश में नए इकोनॉमिक हब विकसित होंगे और बहुत बड़ी संख्या में नए रोजगार बनेंगे। साथियों, आज डिफेंस एक्सपोर्ट्स रिकॉर्ड स्तर पर है। इस बजट में डिफेंस सेक्टर को आत्मनिर्भर बनाने के लिए अनेक प्रावधान किए गए हैं। आज पूरी दुनिया में भारत के प्रति आकर्षण बढ़ा है और भारत में टूरिज्म के क्षेत्र में नई संभावनाएं बनी हैं। टूरिज्म क्षेत्र गरीब और मध्यम वर्ग के लिए कई अवसर लेके आता है। इस बजट में टूरिज्म क्षेत्र पर भी विशेष बल दिया गया है। साथियों, एनडीए सरकार ने पिछले 10 साल में ये सुनिश्चित किया है कि गरीब और मध्यम वर्ग को लगातार टैक्स से राहत मिलती रहे। इस बजट में भी इनकम टैक्स में कटौती और स्टैंडर्ड डिडक्शन में वृद्धि का फैसला लिया गया है। टीडीएस के नियमों को भी सरल किया गया है। इन कदमों से हर टैक्स पेयर को अतिरिक्त बचत होने वाली है। साथियों, देश के विकास के लिए भारत के पूर्वी क्षेत्र का संपूर्ण विकास पूर्वोदय के विजन द्वारा हमारे इस अभियान को नई गति, नई ऊर्जा मिलेगी। हम पूर्वी भारत में कई महत्वपूर्ण इंफ्रास्ट्रक्चर जैसे हाईवेज, वाटर प्रोजेक्ट्स और पावर प्रोजेक्ट्स का निर्माण कर विकास को नई गति देंगे। साथियों, इस बजट का एक बहुत बड़ा फोकस देश के किसान है। अन्न भंडारण के लिए दुनिया की सबसे बड़ी स्कीम के बाद अब हम वेजिटेबल प्रोडक्शन क्लस्टर्स बनाने जा रहे हैं। इससे एक और छोटे किसानों को फल, सब्जियों, अन्य उपज के लिए नए बाजार मिलेंगे, बेहतर दाम मिलेंगे। तो दूसरी ओर हमारे मध्यम वर्ग के लिए फल, सब्जियों की उपलब्धता बढ़ेगी और परिवार के लिए पोषण भी सुनिश्चित होगा। कृषि क्षेत्र में भारत का आत्मनिर्भर बनना समय की मांग है। इसलिए दलहन, तिलहन की पैदावार बढ़ाने के लिए किसानों को मदद की घोषणा की गई है। साथियों, देश में गरीबी समाप्त हो, गरीब का सशक्तिकरण हो, इस दिशा में भी आज के बजट में प्रमुख घोषणाएं की गई है। गरीबों के लिए 3 करोड़ नए घर बनाना तय हुआ है। जनजातीय उन्नत ग्राम अभियान सेचुरेशन अप्रोच के साथ 5 करोड़ आदिवासी परिवारों को मूलभूत सुविधाओं से जोड़ा जाएगा। इसके अलावा ग्राम सड़क योजना 25,000 नए ग्रामीण क्षेत्रों को ऑल वेदर रोड से जोड़ेगी। इसका लाभ देश के सभी राज्यों के दूर दराज गांवों को मिलेगा। साथियों, आज का बजट नए अवसर, नई ऊर्जा लेकर आया है। ये ढेर सारे नए रोजगार, स्वरोजगार के अवसर लेकर आया है। ये बेटर ग्रोथ और ब्राइट फ्यूचर लेकर आया है। आज का बजट भारत को दुनिया की तीसरी सबसे बड़ी आर्थिक ताकत बनाने के उस पूरी प्रक्रिया में कैटलिस्ट का काम करेगा। विकसित भारत की एक ठोस नींव रखेगा। सभी देशवासियों को बहुत बहुत शुभकामनाएं।
देखो कैसे हो रहा है।
I don't think the CNBC did it.
Well, that was Prime Minister Narendra Modi addressing the public of India, the citizens of India, and talking about what budget 2024 aims to do and how it aims to work on various sections, sectors, and segments across the landscape, the economic landscape of the country. Anything remarkable that you took away from the PM's speech, Modi?
No, I mean, it's very detailed, and he sort of expounding on the main features of the budget, and he did talk about went a lot of details about, for example, the fact that the angel tax has been scrapped, about the the which is a granular measure which had irritated the startup sector, and he talked about essentially the measures. He talked about, for example, of one of the schemes announced in the budget which would offer internships in the 100 top companies in India. We talked about young boys and girls being able to work in top Indian in top companies. So yeah, so he talked about the welfare measures of the budget, the employment generation prospects on agriculture. He talked about emphasis on things like vegetable cultivation, defense exports, defense this thing, emphasis on building resilience in agriculture, in with reference to climate change. So overall, a very comprehensive account of what I mean of the main proposals of the budget, and but with obviously with emphasis on the welfare aspects.
So we continue to have Prashant Jain. Prashant, coming back to you, you were talking about banks. You don't distinguish between private and public sector banks, and you hold good quality banks in both. On the consumption side, Prashant, did you see any measures in the budget that gives you the confidence that consumption growth might be back?
We need to understand the background. I think the consumption has grown faster than the economy for a few years, and I think that was driven by a rising leverage in households. And if you are probably you are aware, India's household financial savings, net financial savings, has dipped quite sharply in the last few years. So when you prepone your consumption driven by borrowings, it will lead to some moderation. I think that is what we are probably experiencing. I think the key to growing consumption sustainably over longer periods is through faster economic growth, more investments, more job creation. And that is what the budget is focusing on, honestly. But yes, to some extent, the moderation in tax rates, the tax slabs, I think will provide some relief to the lower income groups.
Specifically, what measures are you talking about which gives you the confidence that we will see a recovery in all of this? I mean, is there anything specific that you saw which can sort of change this equation in terms of private capex coming quickly?
But I think government has to play the role of an enabler and to create space, and that is what is being done steadily. So if you look at the reforms over last decade, IBC, GST, PLI, RERA, improving physical digital infrastructure, the focus on further simplification of direct indirect taxes in this budget, the digitization of land records, property ownership, the endeavor to bridge the gap between demand and supply of skills in labor. I think the government and to create borrowing space for the private sector by continuing to moderate the fiscal deficit. So I think these are all steps that will lead to a recovery in private capex. And I am not disappointed with the progress we have made so far. See, capex is a long lead item. It is not a revenue expenditure that you plan today and you execute it tomorrow. So there is a gap between intent, planning, and eventual capex. If you look at the order backlogs of large engineering companies in India, that has gone up sharp, and that is reflected in the stock prices also. I think private capex is recovering. It bottomed out 2-3 years back, and I think it will continue to grow faster than GDP and to progress over the next 3-5 years. So I would be quite optimistic on continued faster growth in capex, especially private capex, for the next many years.
And what's your take on the power pack, Prashant? You hold a lot of stocks there. There was also this announcement of a BHEL NTPC tie-up for research around nuclear and stuff like that she talked about in the budget speech. Do you see these as fresh triggers for these stocks, or it is just status quo?
Well, actually, these are policy initiatives, but the impact will take many years to show up. I think power stocks, by and large, to my mind, are now approaching fair value, and they will continue to grow. But at the same time, I don't think they are trading at excessive multiples. So I think these multiples should hold, and we can hope to make some returns through dividends and continued growth in these businesses, undervalued as they were in the past.
And one final question, what's your take on the consumption pack? Because last 2-3 years they've not performed. Are these now at valuations that you're willing to look at them?
Well, actually, I feel the consumer staple companies are still quite expensive, and there are better, more promising investments, in my opinion, in other spaces. But the consumer discretionary space, I think, should grow faster, and that is an area of interest to us. Though, to be honest, multiples are not cheap anywhere in India in the consumer space.
Fair enough. Thank you so much, Prashant, for joining in this afternoon.
Pleasure, Mahalakshmi. Thank you. Bye.
We also have with us CEO of the Bombay Stock Exchange, Sundararaman Ramamurthy. Good afternoon, sir.
Good afternoon.
Are you disappointed with the tax changes in the budget? What does it do for your business?
I think it has been a very well balanced budget given the various constraints that are facing the current situation. I consider it as a very well balanced budget.
What kind of sentimental impact do you think this budget will have on investors? I mean, do you think it's when you look at the liquidity in the market and the various constituents, does that materially change retail sentiment?
It appears that the market's retail sentiment is changing. That's why the market is recovering, as you would have seen post the budget. So clearly, the market is the decider, and the market appears to be looking at this a favorable thing because the market is recovering. That is point number one. Point number two is, as far as a specific impact on the investors and the traders, there will always be some pluses, some minuses, because it is a balancing act, as you would say. SCT increase is one part that there is a balancing act taken care of. But if you look at the angel tax abolition, the encouragement given to the SMEs, the simplification associated with some of the short-term capital gains provisions, and some of the long-term capital gains provisions, and overall plan to make the tax statements and the tax laws simpler, They all are towards and also the efforts taken in capital formation for the country, and employment generation and skill development, which will be therefore overall improvement in the saving capability of a retail individual. It's a balanced budget given the constraints. That's how I will put it across.
Right. Sir, are you clear about what is the tax impact on property? I mean, what is the change there? Have you been able to see the fine print?
No, I had not
Long-term
had the
capital gains?
opportunity to see the fine print. What I had realized is that while changing the long-term and short-term capital gain, it was mentioned that specific financial assets, we need to see the fine print. Honestly, I had not had the opportunity to look at the fine print.
So this 10% long-term capital gains is without indexation, but in property there was 20% with indexation benefit. So do all of them align to 12%? You're not clear either.
Not yet, not yet. Honestly, I need to read the full text to become clearer.
Fair enough, sir. So you've seen like 20 years of markets being in NSE and more than that actually. Typically, when taxes, the first time STT was introduced, what kind of impact does it have on liquidity in the near term and in the medium term?
See, it's like this, right? So
And right now,
ultimately,
also just to add to that point, it seems like regulators, government, all of them are aligned in sort of trying to cool off the speculative bubble that is happening in the F&O market. On the other hand, this increase in short term also tells me that somewhere short termism is something that they want investors to move away from. All of
it's
this,
a very
yes.
fair assessment. If you look at any cost which is imposed on the market, the immediate impact it has is on the bid-ask spread, because people who are providing liquidity quote on both sides of the market, and their bid-ask spread is always decided based on what is the cost they incur in a round-trip transaction, as we call it as a round-trip transaction cost. An increase in one of the elements of expenditure will therefore widen typically the bid-ask spread, and therefore in the immediate impact, what it will be is there will be a reduction in the amount of volume that happens. That's exactly what the government also is planning to do, because people do not want a frenzy in trading. People should think what they are doing and have clearly an understanding of what they are doing. And it should not be a one-way street of just rushing towards an opportunity to trade. So therefore, when the bid-ask spread increases, the ease of coming in and going out is slightly sort of impacted, resulting in therefore more of a thoughtful volume, not of a frenzied volume. And once that happens, people start getting into an education curve and learning curve, and post that the market recovers and liquidity recovers, because more and more people who understand it then come into the market, and the prices gets factored in, and the volumes return and liquidity return back to normal. That's what I have seen in my past.
But then, considering the fact that the large constituent in that market is only retail, and if that's going to go out, is there any constituent that can actually replace it? Because institutional volumes
Honestly,
cannot make
no.
up for it, right?
Honestly,
so what goes out goes out.
I'm not able to see it that way. I'll tell you why. We are able to define clearly who is a foreign participant institution. We are able to clearly define who is a domestic institution. We are able to some extent at least clearly define who is a proprietary trader. Whatever is balanced, we are calling it as retail. Is it a homogeneous mix? It is not. In the retail, there are big high net worth individuals who trade heavily, and who are big people who have a lot of money, who have a lot of capabilities. And where we also have very small investors who are only trading one contract or one share. So therefore, considering everything as retail in itself is probably not a right thing. That is one point I wanted to make. The second point is, are we right in saying that they are the majority player? I don't think so. If the majority players are retail, who is on the other side, right? So today, when you look at it, it is domestic institutions, foreign institutions, HFT players, who are all very, very big in their own way. They are on the other side. So retail is just one portion of it. And in that, if you were to classify it as retail, taking away the HNIs and big participants, it will not be a very big proportion. It should be around, if you look at the F&O data, the very small retail participant contribute for less than 1% of the total volume of F&O. Their numbers is around 50-60% of the total retail, what you call as retail today, and they contribute only for 1%. The balance, who are actually very big retail, if you want to call them that way, or if they are probably high net worth individuals, they contribute for the bulk. So to just say that retail contributes the maximum volume, and therefore any bid-ask spread and therefore impact will be totally driving them away, may not be a fully correct picture, is my view.
Sure. If we were to, fast forward 1 year from now, do you think overall volumes and liquidity in the market will be higher or lower? That's question number one. And you think where will Sensex be?
Honestly, I wish I have the capability to see. I don't think I'm able to fast forward and look at 1 year down the lane what the market will be. Market is always full of surprises. That's what the market is, and that's why it is so interesting. I'm not able to forecast what it will be. What I am able to certainly forecast is, on this day, particularly when a very forward-looking, very balanced budget has been given, India's future is certainly very good. Its capability to reach newer and newer milestones is very good. Think about the provisions which have been made for innovation, research and development, next generation reforms. Clearly, it is forward. I'm sure because of that, no, and look the fiscal consolidation, fiscal discipline. Clearly, therefore, India is poised to grow in a big way. 1 year, what? Next 3 to 5 years, with the growing trend of growth and the GDP increase, India is poised for a great growth. Market is just one part of it. It's not the everything and anything of the entire economy.
Sure, sir. Thank you. Thank you so much for joining in this afternoon. We also have Nilesh Shah, MD of Kotak Mutual Fund. Hi, Nilesh.
Hi.
Your first thoughts on the budget. Are you delighted with the fiscal consolidation path, or are you ruining the hike in the taxes?
So I'm absolutely delighted by the fiscal consolidation in the budget. It is well beyond market's expectation. Last year, the fiscal deficit was 5.8% when budget was presented. And now we are talking about 4.9%. More importantly, with tax buoyancy, potential divestment, and potential higher dividend from the RBI as well as the PSU companies, this number can even surprise further. On top of it, there is commitment for 4.5 fiscal deficit for next year, and also commitment to reduce India's debt to GDP ratio thereafter. I won't be surprised if India becomes primarily surplus country from primary deficit over next 3 to 4 years. Combined fiscal deficit of center and state will be less than 8% after some time. So fiscal consolidation, absolutely delighted. And the valuation positive effect of fiscal consolidation will be far more than some increase in capital gains.
Fair enough. Nilesh, what kind of sentimental impact do you think this change in capital gains tax will have? And more importantly, are you clear on what has changed with respect to property tax? I mean, with respect to real estate long-term capital gains, are you clear about what is the change?
So again, this is Gyan from WhatsApp University. I believe there was 10% without indexation and 20% without indexation for capital gains in property. And the period was 3 years. Now 3 years has become 2 years, clearly benefiting property owners. And 10 and 20 without indexation has been merged into just 12.5% without any indexation benefit.
So what that means is equity long-term capital gains, property long-term capital gains is all now a uniform rate of 12% Absolutely. Without indexation.
Absolutely.
So how does that change the complexion of equities then? I mean, does it materially change? Because people, at least the fact that, property real estate has not performed over the last 10, 12 years is also a key trigger why people are now looking at equities in a big way. Do you see that as a trigger for a reverse migration?
And I think the real estate industry has a serious need for introspection. In which part of the world borrower of your product gets interest rate cheaper than the producer itself? An automobile company borrows at a much cheaper rate than the consumer who is doing auto financing. In real estate, housing loan borrower borrows at a much cheaper rate than the real estate developer. So clearly, real estate is an important part of individual's portfolio, but the real estate industry has to evolve in terms of transparency, governance, and consumer satisfaction. If you compare financial product versus real estate, there's no investor protection in real estate industry. In financial industry, you are protected. There is regulator who will listen to you. There is governance, and that is reflected into the borrowing cost of real estate industry versus financial industry. So I think more than the taxation, it is the governance practices which will bring investors flow towards financial services.
Why do you say that, Nilesh? Because with RERA coming in, I thought some of that problem was getting sorted out. Do you think that it's still a problem? And I know that, you know, real estate has wanted this industry status for a long time, which has not happened. Um, Tell me what makes you uncomfortable about real estate even now?
So, Mahalakshmi, undoubtedly there are good apples and there are bad apples. I'll give you just one example. 10 years back, I bought a property in Andheri East. At that point of time, there was no metro there. The builder was supposed to deliver fully furnished house in certain manner. For 10 years, he hasn't delivered, and I have sold the property at loss. Now, yes, of course, there is RERA, and I can go to the court and consumer forum and fight it out. Do I have time for it? I don't think so. What is the governance structure in the real estate industry? Can a auto loan borrower will be borrowing auto loan cheaper than Maruti Suzuki? Answer is no. Then why is a home loan borrower getting a rate better, far better, multiple times better than the real estate developer? Undoubtedly, there are many listed real estate players who are focused on building brand. They deliver fantastic reflected into the price they are getting for their property. But unfortunately, there are bad apples also in the basket.
So as a pack, are you underweight real estate in your portfolios?
So we have generally played real estate cycle with very few real estate developers and more via the building materials, building supply chain kind of companies. As I mentioned, there are good apples in real estate, there are bad apples. As an investor, I'm supposed to invest with good apples, not with the bad apples, even if they deliver higher return.
Okay. And after this budget, Nilesh, do you see any shift in strategy? Has anything changed materially for you to look at your portfolio weights of various sectors, etc.?
So we will be looking at fine prints to make some modifications here and there. But Mahalakshmi, when I'm investing, we are investing with 5-year, 10-year horizon. Budgets will come and go. Your basic investment thesis is unlikely to change because of certain budget proposals. Undoubtedly, fine prints, we will make adjustments, but by and large, no material impact on portfolios.
And this year, what is your outlook on earnings and what does the budget do? Do you think there are enough triggers for earnings to accelerate or at least replicate the growth of last year?
Last year, growth was in 8 big figure. This year, growth will be in 7 big figure for GDP. That will be somewhere reflected into earnings growth. Will earnings growth slow down a little bit as GDP growth slows down? Answer is undoubtedly yes. More importantly, global pitch has also changed. There is more protectionism. There is slower global growth. There is withdrawal of monetary accommodation globally. Put together, earnings growth is slightly to decelerate. If we get earnings growth of 10 to 15% this year, I think that will be a good achievement.
Fair enough. And the way you are portraying it over the next 12 months, do you expect a deeper correction Because we've not seen a more than 10% correction so far since the pandemic.
So my feeling is
except
that the
the
cause of the deeper corrections will be more external than internal. We trade at a premium to others because we are doing well and others are doing badly. I have confidence that we will continue to do well, but I don't have confidence that others will continue to do badly. If those guys do course correction, then certainly some of our premium valuation could come under pressure and there could be some amount of correction. I still believe a big, deep correction is unlikely to happen. At best, we will have time correction. This is primarily because there is Triveni Sangam of fundamentals. Corporate earnings growth will grow between 20 to 25% over FY25 and FY26. That makes India's price to earnings growth ratio reasonable. Governance structure in India is far better, and we are getting domestic liquidity. So I will say deep correction in broad market extremely unlikely unless triggered by a global event. Of course, there is froth in low floating stock counters, concentrated holdings. Those stocks will correct.
Fair enough. Thank you so much, Nilesh, for joining us this afternoon. Over to you, Karanya. A quick market check.
Yeah, there's been a recovery for sure from the day's low. I was looking at Sensex also a while back, and yeah, similar kind of a up move or a crawl back rather that we've seen for the markets. Nifty right now trading with a loss of 0.2%. 24,457 is where we're exactly perched at, and a similar mild subtle recovery has been witnessed even on the BSE Sensex as well. Let me quickly pull up the top gainers and losers list as well. Of course, on the Nifty 50, a clear winner today is Titan, the kind of fantastic up move that it has seen and it continues to see even now is remarkable, followed by the likes of ITC, again another one from the consumption pack, which is looking fairly strong. You also have Tata Consumer, which is also one of the top gainers on the Nifty 50 today. But on the flip side, L&T, Hindalco, ONGC, Power Grid, these are the kind of large scale companies which are from the oil and gas sector, manufacturing sector, which seem to be a little not little, but a little, actually more than 2.5-3% lackluster, 2.5-3% lower in trade as we speak. Top losers on the Nifty 50. In fact, Bajaj Finance, Shriram Finance, HDFC Bank, these banking heavyweights are also weighing on the weakness today in the market. Clearly, Mahalakshmi, for the banking space specifically and private sector lenders, I mean, is the reason that they're sulking right now in trade because there was nothing significant, nothing remarkable announced directly or indirectly that benefits the private banking space?
I don't think there was anything good or bad for
that's what
in this budget, because there is for the bond markets, which is their treasury operations, it's at the margin a positive because there is no surprise. I mean, borrowing figure is pretty much the same. So how do you really care? Otherwise, I think in general, I think the market mood right now, I think Nifty is up just about 20 points, is it?
It's flat. I mean,
it's flat. It's flat. So that's the thing. I mean, we were discussing this in the morning also, that this is such a strong bull market that whatever negative comes is the market is willing to shrug it off. And I think just today is a fairly uneventful day, and whatever we see on the screens, whether they're gainers or losers, is just because somebody's taken a position. And there is no clear winner or loser from
the
this
usual
budget.
suspects, your infra stocks, your cap goods, manufacturing, your banks, very lackluster. I mean, they're just keeping up with the overall market mood, which seems to be a bit sluggish.
Absolutely, because first of all, it is more of the same. The capex spend continues to be the same. We're just looking at all the spending segment wise, and there is really no big change in the spending pattern of the government. The overall big number also continues to be the same. and it's very hard to identify. And some of the announcements, for example, related to power, etc., that were made were not significant enough to be a trigger for any particular stock. It's the same old stuff, right? Urban housing they talked about, so affordable housing plays. These are all factored in, and if you know, if you see, barring Friday and Monday was a flat market. Friday we gave up a lot of the gains. Past 6-7 weeks we have seen the market only rise in anticipation of all this, the rural plays that she talked about so much, the agri plays, the fertilizer stock was the only part which has been very disappointing. And all the capex plays, the industrial stocks, all of those have rallied over the last 6 weeks, right? So we didn't have any substantial trigger for them to rise from whatever was announced today, because those are not concrete steps that is resulting in anything. The second thing is, I think on the consumption stuff, I think I'm still not very clear that what are those triggers in the budget which is going to immediately give you the confidence that this year's earnings growth is going to be better than last year.
The fact that one can still fathom why rural or FMCG stocks with more rural exposure are doing well, because they're okay talking about increasing uh, household income. They're trying to get people more employable, skilled, etc. But what's more curious is the discretionary index and the consumer discretionary names, which are also rallying a fair bit. And Titan, of course, is an exemption, and it's reacting to the customs duty on gold and silver update. But I mean, look at a Blue Star, V-Guard, Bata. I mean, these are pure consumer discretionary companies, and they're also looking fairly resilient amid all the sluggishness in the market. So yeah, clearly, I mean, the outliers today, FMCG and followed by consumer
I think
discretionary.
durables, there is still a case, because I think the durable pack was especially low ticket consumption items were the worst hit in the last 2 years in terms of demand, suppressed demand.
Yeah.
And there is obviously some reason to believe that demand may be coming back. In any case, I think the total manufacturing numbers also showed a recovery in the last 2 months, which is a positive. So they might, but the fact is also, Karunya, that in most of these companies, earnings have been depressed in the sense that you've not seen the kind of growth that we saw before, in the before 2019, 2021 was also a very good period, but after that we saw the sluggishness. But stock prices have not corrected so much. So in a sense that earnings growth story did not pan out, but the stock prices did not correct. So they're not like seriously undervalued or anything that people should jump in and start to buy these stocks. Anyway, we'll talk a little more about that later. But we have Saurabh Mukherjee joining us from Marcellus. Hi, Saurabh. Good, bad, ugly. Sorry, can't hear.
Not hear me?
Yes, we
I
can.
was saying, I thought it was a brilliant budget. Full marks to the FM. If I had to give marks, I would say 8 or 9 out of 10. She took on this whole stock market mania head on and said, come to your senses, stock market investors. Here's a 20% short-term capital gains tax in case you guys can't smell the coffee. She said to the stock market. She acknowledged that employment was a massive issue. I thought there were 5 distinct measures to juice up employment. I'm not so sure all of them will succeed, but even if 2 to 3 measures succeed, I think we'll see significant relief on what is a pretty serious employment crisis in our country, I reckon. And furthermore, there was acknowledgement that rural India also needs money, that 1.25 trillion allocation to rural India. But what was most significant was there was acknowledgement that this whole capex mania has to be throttled off, and the government has to spend on the poor, on the unemployed, on urban housing. And I think that's a significant shift in direction. I would say this is the most significant policy shift I've seen from the NDA in the last 3 or 4 years. And this is a lot like the budgets we got accustomed to in the coalition era that we used to inhabit pre 2014.
So what does that mean for the market, Saurabh? And also, What does this do to the consumption space? This whole rural spending and employment, all of it is welcome also, considering that in the last 3 years, that side in the budget, it was not really an area of priority in the budget. Capital spending took priority. Now there is this shift. But all of this from a stock market perspective and consumption growth perspective, do you see that panning out this year?
I think this is a very significant budget. If you think about it, we have a polarized stock market where companies that are reliant on the government for capex or PSUs have done exceedingly well over the last 2 to 3 years, whereas a whole raft of other companies, whether they be focused on consumption or they be focused on consumer lending, those companies have struggled, as you're saying, from macroeconomic reasons. This is the lowest consumption growth India has clocked in the last 2 decades, given that we are one of the 50 poorest nations in the world. For one of the 50 poorest nations in the world to have 2-3% consumption growth in real terms is a serious issue, and that's been reflected in the stock prices of the FMCG names, of the consumer durables names. I think you and your colleague were just discussing. I think the FM is effectively saying that, look, we hear you, we understand the situation, and this is the beginning of remediating the employment issues, the consumption issues that afflict much of the population. To finance that, in coming budgets, they'll have to throttle off further on public sector capex. It was notable that there was not 1 rupee increase in public sector capex between the interim budget and the final budget, whereas RevX or pro-poor spending rose by my estimate, 3 to 4 trillion.
Fair enough. Bodhi?
Saurav, this is Bodhi here. I just wanted to ask you just on a theme. So you see the rise in the capital gains tax, both long term and short term, as a deliberate measure to cool down the market, and also the STT on derivatives. I mean, you see this as a deliberate measure to cool.
I think it's a measure to cool down the markets. You're absolutely right, Modi. But I think I see it as a lot more. The government is effectively saying that, look, you are business people out there, you're entrepreneurs, business families out there. You guys are taking your hard-earned money and sticking it into the stock market in the hope of a speculative gain, rather than investing it in the real economy. Private sector capex is weak, and the stock market is roaring. And I've met hundreds of business families who are taking their surplus, sticking it in the market, because they're saying, if I can pay 10% LTCGT, whereas corporate tax is 25%, why should I even bother growing my business? I'll just simply stick it in the stock market. I think that's a serious issue. I think over the next 3 or 4 years, the government will try very hard to bring the corporate tax rate and the LTCGT rate close to each other. At the moment, it's 12.5. After today's change, it's 12.5 playing 22 being the corporate tax rate. I think over the next 4 or 5 years, the corporate tax rate should come down and the LTCGT rate should go up. Otherwise, you simply cannot grow an economy like this. You can't let people take business surplus, stick it in the market and speculate. And I thought it was a brave acknowledgement by the FM. LTCGT, it's a token increase. It's an acknowledgement that there's more to come. And the STCGT was clearly an attack on speculative activity in the market.
The STCG is actually very close to the corporate tax.
Saurabh, hi, if you can hear me, this is Nandita here. Just want to ask you, you've given the FM full marks for this budget, 8 out of 10 and all, but in terms of FII positioning, you think now they'll be ready to make a beeline to India? Of course, they have turned buyers. It's in sharp contrast to how they were positioned before the elections. So here on, do you think there will be more inflows? Do you think that the recent reversal that we have seen in the trend when FIIs have made a comeback, do you think this is sustainable going forward now?
I think if you look at the stocks that the FIIs have bought post the election, and the reason I'm aware of this is because these are Marcellus stocks. The FIIs like consumption, they like private sector banking. The FIIs are not particularly keen on loading up on government capex, because government capex tends to come and go depending on the political realities on the ground. And to the extent that the FM is signaling that the wind is blowing in favor of the government helping consumption, the wind is blowing in the favor of the government juicing up employment, I think this sort of budget is pro FII. What's even more encouraging, I think, from a long-term investor's perspective, whether it be FII or DII, what's even more encouraging is the government is saying, not only will I stoke consumption, not only will I try to juice up consumption, I will do so without compromising on fiscal rectitude. I think that's just brilliant. 4.9% was a pointed signal by the FM that I can help the poor without abandoning fiscal discipline. And if I need some money for that, I'll get it from the stock market.
Sort of just to play devil's advocate, I mean, your logic certainly is quite compelling on what you talked about, the why the government raised the tax on capital gains at many levels. But just to play the devil's advocate, as it were, suppose I mean, one of the aspects of the stock market boom has been the retail money coming into stock markets and SIPs and so on, which has gone up exponentially since 2020, and the number of such investors is far more than, let's say, 6 or 7 years ago. um, do you think that would, and that is said to have acted as a source of stability and as some kind of a counterforce, a countervailing force to FPIs, to portfolio investors who, were hitherto dominant? Do you think that they might be discouraged from investing in stock markets, or indeed in mutual funds, SIPs in mutual funds, not individual stocks, obviously? Do you think that might discourage them? I'm just putting a contrarian argument here.
So I think what the government is, I think, very clearly trying to discourage. If I look at the tax changes today, is speculative activity, whether it be in the FNO market or in the cash equities market. Hence the doubling of the FNO tax and the jacking up of STCGD to 20%. The government is saying, I'm not that keen to bang you up on long-term capital gains tax, hence almost a token increase, 10 going to 12.5. And to the extent that the domestic retail money coming in, whether it's via SIPs or straight into PMSs like ours, to the extent that that is long-term oriented, I think that continues in light of this budget. To the extent there are punters in the market coming in trying to have a flutter, whether in the FNO market or in cash equities, I think that clearly will get discouraged. And what I can make out from SEBI's stance on this and from the FM's announcement, if this doesn't work, then in the next budget there'll be another dose of this until the short-term speculative activity cools down. The FNO market volumes that we have in India, there is no rational justification for it. Neither is there any positive economic good coming out of that.
So Saurabh, I mean, just as a follow-up to what you're saying, I mean, if the idea is that the FM is trying to tell, especially family offices and high net worth individuals who are also sort of taking money, but all the promoter stake sales that are happening are also getting redeployed into the stock markets, and that's a big source of liquidity for markets, which is what is causing this stock prices to continuously go up. Does that go away? Is this enough to dissuade that money to go away from the stock markets?
I think what I see, if you again link this to the fact that the buyback tax has been made so attractive, unless somebody's out of their mind, no company will now announce a buyback through a variety of means, to the means you just highlighted, Mahalakshmi, and through basically eliminating the buyback as a viable option. And remember, dividends are also already taxed. The signal to the promoter community is very clear. You guys invest company surpluses into the real economy. If you don't want to invest company surplus in the real economy, we will tax you as you try to sell stock and try to monetize that through your personal family offices. I think the signal is very, very clear. Whether the promoter community will heed that or not is something that we will see in the coming months. But through the kind of combination of tax measures that have been announced, I think the government is sending a loud message to corporate India, saying, get on with it, get the capex program going.
So Saurabh, if that were to be the case and it actually turns out that way, that will be a significant negative for the market, isn't it? Because this has been a big source of liquidity for markets.
If you give me a choice, Mahalakshmi, between what would I rather have? Do I want to see promoters selling stakes and setting up family offices, or do I want to see promoters doing corporate capex? I think my vote will be in favor of the latter. Private sector capex is weak for no justifiable reason, and I think both from macroeconomic perspective and from a corporate earnings perspective, we would rather see companies reinvesting their surpluses back into the stock market rather than liquidating stakes and setting up family offices.
But I mean, it is one thing to say that people are prioritizing stock markets than private sector. A businessman, if they, especially somebody who has an established business, do you think people are actually seeing growth and seeing this as easy money and coming into markets, or is it a lack of confidence in growth?
I guarantee you they are. I've spoken to hundreds of SME owners. Their point is, why should I work hard, reinvest in my business and get taxed at 25% or 22% if I can stick it in the market and and get taxed at 10%. And I can understand that, right? To be honest, even Marcellus' balance sheet, we have invested a fair bit of our money from the balance sheet into the market rather than growing the business. Because why shouldn't I? If I can pay long-term capital gains still this morning of 10% and even tomorrow morning at 12.5%, that's a lot easier than setting up offices, hiring young people, training them, right? Why should I do all that hard work if the market will give me easy wins at a capital gains tax of 12.5%? So I think this is a signal from the government. They are indicating to business owners like us, invest in the country, invest in the economy. If you don't do that, then the long-term capital gains tax will keep getting close to the corporate tax rate, so that business owners like me don't get an arbitrage between what the corporate tax rate is and what the capital gains tax rate is.
Sorry. So does that mean, is that a negative for stock markets? I'm sorry, I'm asking this question again.
I think it's a good thing. I think, see, the stock market ultimately hinges on the economy. The economy is driven by private capex, right? We need to get private capex going, and the government is giving every indication that they will do whatever it takes to get private capex going. The stock market doesn't exist in some void where you can have an economy running without private capex and the stock market boom. It doesn't work like that. So that this is good for the economy. The budget is good for the economy. Anything which is good for the economy is fundamentally good for the stock market in the longer run. There is no trade-off here.
Okay. What are your top bets? Anything specific in the budget that creates triggers for any new themes to emerge
So
from here on?
we've been invested in much of these things for a long time. So amongst agri stocks, we've been invested in Eicher and Godrej Agrovet for a while now. Amongst the consumption stocks, we've been invested in Titan for many years. Tata Consumer, we built a position more recently. On the women-centric stocks, we've been invested in Trent and Nestle for a while now. And in building materials, we've been invested in Asian Paints and Astral Poly for many years, similarly Pidilite. So much of what's done well in the budget, we've been invested in for many years, and we'll carry on like that. I mean, I never could understand in the first place why the wild rally in government capex stocks took place. And that was why I was so happy to see that after the election, the FM kept the capex spend frozen and jacked up the revenue expenditure, focusing specifically on employment, consumption, and rural areas.
So you see, consumer durable companies rallying from here on. We were just talking just before this conversation that, any consumer durable company you look at, and some of them you've also owned, like Relaxo and all of these, even though earnings growth did not pan out very well over the last 2 years, most of these stock prices did not correct so much. So in terms of overall valuation, they continue to be fairly, I won't say overvalued, but it's not cheap.
Yeah. So Relaxo we sold a couple of years ago, but I take your point on the broader consumer environment. A lot depends on will you see consumer durable companies or consumption companies earnings rally? I think a lot depends on the measures that the FM announced. Do those result in incremental employment? My first reading of the FM's measures is those measures will result in meaningful gain in employment. If that comes through, that I think gives a fillip to consumption. I think the next thing to look forward to then is the election results in October. What happens in Maharashtra, Haryana, and Jharkhand? I think that again has a bearing on how the budget in February shapes up. But my reading of both the political and the economic situation is we went to sort of one extreme on in terms of the market running away from consumption, the economy seeing weak consumption, and now gradually the needle will correct back to we get back to say 6-7%, which is long-term consumption growth in India. And hopefully the capex, private sector capex piece now picks up, and rather than government capex, private sector capex now drives the economy forward, especially as the interest rate cycle comes off.
Sure. Nandita, you want to ask a question?
Just want to ask, you mentioned some of the things, in the women-centric names. Would you look at Nykaa now? Saurabh, has your view changed? I remember post the interim budget, when we were talking, we were mentioning how Nykaa also forms a part of the entire women-centric theme that the FM had highlighted. How would you look at Nykaa now as a stock?
and a team that make a fabulous business. The share prices have come off sharply over the last year or so. So it becomes interesting. Keeping a close eye on capital allocation, we would rather they didn't allocate capital beyond the beauty and personal care vertical. The fact that they are allocating capital to apparel worries us a little bit. But that being said, the valuations have come up and it's interesting. So we'll carry on doing some more research on it. I won't be able to tell you more than that at this stage.
Right. And in terms of valuations and earnings, do you think current valuations, are being justified by the kind of performance we've seen from the companies thus far? Or would you be a little uncomfortable because, it could be somewhere around 22, 23 times? Do you think some bit of correction is warranted if there could be, or if there is a disappointment from other sectors? Because IT, we went into the earnings season with very low expectations when it comes to IT stocks. Perhaps that's why they have really managed to impress, even though there's been no tangible improvement in the discretionary demand environment. But would you see more pockets of outperformance from this particular earnings season? And if not, do you see some bit of some chances of correction here on? Because we've climbed all the walls of worry thus far, and even now today, we've made a 500-point recovery from the day's low. So could earnings be that trigger for a correction going forward?
I think there is a big part of the Indian market which is overvalued. A big part of that is around government-owned companies, around government capex-focused companies. There's hundreds of small caps whose valuations make no sense. Clearly, there is big pockets of overvaluation in the Indian market. That being said, because of the very sort of distorted nature of the stock market rally over the last 3 years, where quality has stayed on the sidelines, the sorts of quality stocks we invest in, their PE multiples today are no higher than they were 5 years ago. And Asian Paints today trade at much the same 35, 40 times PE multiple that it traded 5 years ago. And HDFC Bank, in fact, trades way lower. I think it's at a 20-year low on PE multiples. Similarly, say a Kotak Bank, right? So high quality names haven't had much of a rally in the last 5 years. And I think that presents a delicious opportunity for people like us who are saying that, look, the economy is in good shape. Corporate India's balance sheet is the strongest it has been in 20 years. Banking system balance sheet is at a record high. Tier 1 ratio in India is an all-time high. In fact, it's the highest in the world. Interest rate cycle is peaked, likely to come down, and therefore you couldn't really ask for a better macroeconomic environment, and you're getting to invest in quality names at the same P multiples that prevailed in 2019, 2018. So we have a distorted market, low quality overvalued, high quality undervalued, and our job is to optimize that mix that we are presented with.
Thank you so much, Saurabh, for joining us this afternoon. Now we have Amit Jeswani, founder of Stallion Asset. Amit, good afternoon. From morning
Hi,
till
good
evening,
afternoon.
have you got any new stock ideas?
Oh, from the budget.
From the budget.
Lakshmi, I'm not able to hear you properly. Your voice is very low. But we've not done
New
anything.
stock.
We've been on
Please go ahead.
We've been on some cash, Mahalakshmi ji. We're just finding new ideas very aggressively. The earnings season has been very, very, very weak. So we've not been able to allocate capital very aggressively. So we've bought some auto ancillary companies here and there, some port management chain, some special situations we've done. Uh, we bought some real estate companies today. It's the same thing. Nothing changes. Yeah, we're buying growth. We're buying market leaders, companies who are executing very well and creating market leadership in their segment.
Were you a tad disappointed by the, no increase in capex spending? Is that a big part of your portfolio?
This was expected. I don't think it would have made a difference so much, but it's okay. I was very disappointed with capital gain taxes, but it is what it is. You can't do much about it. We make a lot of money and it's okay to pay some more taxes now.
Fair enough. So what is your strategy going forward, Amit? Because you are an out-and-out growth person and more so in companies which have moats, etc. We've talked about it. Does that change in any way especially after this
Lakshmi,
budget?
I'm not able to
Do
hear
you see
you very
fresh?
properly. If you can, I don't know why the voice that I'm not able to get proper volume of what you're saying. But my strategy doesn't change at all. Our strategy remains to buy growth across industries, and wherever we find growth, see, Mahalakshmi, for us, budget. After 2 days, no one is going to speak about budget. It will be only about earnings. If you see today, one wind energy company came with earnings yesterday. The earnings was a beat. The stock is still on upper circuit. This is India's largest wind energy player that I'm speaking about. Wherever, so we don't have that company in our portfolio, but wherever there is earnings, wherever markets are seeing growth, that is where the bidding will continue. This bull market. See, Mahalakshmi, today the news is very bad. If you would have asked me in the morning, what would market react if the government increased short-term capital gain tax from 15 to 20%, long-term from 10 to 12.5%, I would have told you the market would be down 2% at least, or 3%. But this market is flat or now positive probably. So this market is not reacting badly on bad news. The markets are giving us signs that we are in a bull market. The markets are climbing walls of worry. The government getting 240 seats didn't impact this bull market. The budget not being as per market expectation. I didn't see a lot of people. Everyone was speaking about option speculation. Getting taxed, but no one was speaking about hike in capital gain tax. At least not many people were speaking about hike in capital gain taxes, and that was the case. But the markets have been very strong today, and if the market stays strong on these negative news, it is telling you that it doesn't want to go down anymore. And liquidity, and it's the same thing. Liquidity गिरने नहीं देगी.
Tell me about the real estate pack, Amit. Do you hold any real estate stocks? Because this is one section that has done exceptionally well. And of course, even in the budget, there is a lot, on housing. Does that look like a credible play from here on?
Apologies, I'm not able to hear you at all, Mahalakshmi.
Okay, maybe Nandita. Nandita, you want to jump in with some of your questions?
I think Emil was asking you about the real estate pact, the indexation benefit being removed. How do you really see that? And, how does the realty pact look like here on? Amit.
Hello?
Amit, is my voice reaching you?
I think it's a problem with his, probably with his
I
mic.
think there seems to be some audio issue. We will get that fixed, but just want to get you a market check on that note. Very flat. In fact, we've given up those mild gains that we were witnessing just a while ago. So we are down, some 30 odd points. No big fall coming in, but we are somewhat volatile after the day's low. In fact, we are waiting for the finance minister's press conference also post the budget speech. It will begin anytime and we will cut across once she starts. In fact, the press conference has just started. Let's cut across. Okay, so the FM will be starting her press conference, so the post budget speech press conference. Of course, okay, we will come and cut back to the finance minister once she starts speaking. I think she has started speaking. Okay, Amit, we were talking about.
Let us speak.
She can't see the
Budget
screen.
and also seek clarification. For your, just for a matter of drawing your attention, we've put up a single slide which has used the word employment as an acronym to capture that is everything in the budget. So each letter actually highlights the important points of the budget, and we can elaborate more on that a bit later. But employment captures everything to do with this budget, and I would like you to, for a moment, spend a time on it. And deriving from that, everything which has been said in the budget falls in place. But with that said, yes, your question is on the point there is we wanted to simplify the approach to taxation also for the capital gains. One. Second, if anything, the average taxation actually has come down when we say it is 12.5%. Because we worked out for each of the different asset classes, each varied with the indexation. I'll ask secretaries to elaborate on it. But the point that we brought it down from below the average to 12.5, which is the lowest if you can look at the last several years, encourages investment in the markets. With that said, I'll ask Somanathan or who is going to elaborate, Sanjay, on the specifics.
So you had there were, I think, two or more parts to your question. One was on real estate and gold and other assets. So earlier the rate was 20% with indexation. It has now been reduced to 12.5% without indexation. If you assume that the rate of return on real estate is typically above 10% per annum, and if you take inflation at about 4% per annum, the real rate of return was earlier, let's say, somewhere between 6 and 16% per annum in real estate. If it was 16%, 20% of 16% was being taxed. The effective rate was 16%. It has gone down to 12.5%. If the rate of return was 10% per annum nominal, it has also remained approximately the same at 12.5%. So actually there is either a reduction or no change in respect of the effective rate of tax on property and gold. As regards the equity, yes, it has gone up from 10 to 12.5, but you'll also find that unlisted equity has gone down from 20 with indexation to 12.5 without indexation. Basically, we have a very, very simple, easy regime. All listed, all unlisted are at 12.5% long term. And all are at 20%. I mean, equities are at 20% and everything else is at applicable rate for short term. So yes, short term has gone up, and yes, long term has been rationalized. It has not necessarily gone up. And Sanjay, would you like to add anything?
One point I would like to add over here is that we also need to keep in mind as to the kind of people who are actually paying these taxes, the capital gains on the securities, the listed securities especially. And so over there, when we did this analysis for the year 22-23, we found that about 88% of the tax is actually coming from people who have an income of more than 15 lakh. 61% of that income is actually coming from people who have an income of more than 1 crore.
That is income on capital gains on this.
And we are all aware that otherwise, the standard rate is, about 30%. And for some, it can go up to 39%. So this marginal, very small marginal increase is actually impacting only those, primarily those who have an income of more than 15 lakh rupees per year.
Okay, number 3.
On capital gains.
Ma'am, Timsi Jaipuria from CNBC TV 18. You announced a very lucrative new tax regime with changes in tax slabs. A lot of new changes are there in the income tax side, on the revenue side. And in the speech, you mentioned that revenue foregone will be around 29,000 crore rupees, whereas government will now try to mobilize around 30,000 crore rupees. What will be these revenue mobilization measures? And from where do you think this foregone revenue will be recovered? If you can highlight, where are you foregoing the revenue and where are you going to recoup this revenue from?
First of all, it is not just because we've mentioned it in this budget, but the attempt to widen the tax net is something which we've been repeatedly saying, that India's tax net will have to be widened, whether it is in the direct taxation or indirect. Second, there are also now the PSU dividends which are improving because the valuations have gone up really high. And their performance is also now substantially increased. So revenue mobilization is not just tax based, you have non-tax revenue mobilizations which are also coming up. Then we had, for almost now 3 years, been talking about asset monetization, which is not selling of assets, but optimum utilization of those assets which are lying in the form of unutilized stadiums or land which is available with PSUs, which can be utilized for better purposes. That's a third one. Fourth, you're also looking at generating resources from newer areas. So in all those, the revenue is going to be mobilized better, and as a result of which, the revenue foregone will be now made up for. Is our
Well, those are some important clarifications coming in from the Finance Ministry on, on realty indexation benefit being taken, being removed, and of course the LTCG on realty being reduced to 12.5% from 20%. But let's now also listen into some of the political reactions that are coming in on the budget that was presented in the Parliament by the Finance Minister today.
वित्त मंत्री निर्मला सीतारमण जी ने जो बजट प्रस्तुत किया, हम कह सकते हैं आधुनिक भारत के निर्माण में सहायक सिद्ध होगा। 2047 में विकसित भारत का संकल्प का सपना जो देशवासियों ने माननीय मोदी जी के मार्गदर्शन में देखा है, उसको पूरा करने वाला बजट है। एक तरफ छात्रों की चिंता की गई है, किसानों को भी मजबूती देने का काम किया गया है, मध्यम वर्गीय लोगों के जीवन स्तर को ऊपर उठाने के लिए प्रावधान किए गए हैं। इनकम टैक्स सीमा में छूट देकर के सरकारी कर्मचारियों को भी बड़ा तोहफा भारत सरकार ने देने का काम किया है। मैं बजट का बहुत बहुत स्वागत करता हूं और माननीय प्रधानमंत्री नरेंद्र मोदी जी को, वित्त मंत्री आदरणीय निर्मला सीतारमण जी को बहुत बहुत आभार प्रकट करता हूं और पूरे प्रदेशवासियों को बहुत बहुत बधाई।
मैं समझती हूँ किचन का ध्यान नहीं रखा गया है, क्योंकि सरकार महंगाई के बारे में कोई स्टेप्स लेना ही नहीं चाह रही है। और जहां तक हम देखेंगे तो जो परचेजिंग पावर है जो रूरल एरियाज में है वो लगातार घटती जा रही है, इसके ऊपर भी कोई ध्यान नहीं दिया गया है।
यह बजट सर्वस्पर्शी, सर्वसमावेशी, विकासोन्मुख 140 करोड़ भारतवासियों की आशा, आकांक्षा और अमृत काल के संकल्पों को पूरा करने वाला सिद्ध होगा। आम बजट 2024-25 आत्मनिर्भर एवं विकसित भारत के निर्माण का एक आर्थिक दस्तावेज है।
मैं विकसित भारत का आधार पर जो बजट प्रस्तुत किया गया, मेरी अपनी ओर से बजट की बहुत बहुत बधाई। मैं माननीय वित्त मंत्री श्रीमती निर्मला सीतारमण जी को भी बधाई देना चाहूंगा, जिनके माध्यम से भारत की चमक और महंगाई दर पर कंट्रोल करने की जो भावना है वो परिलक्षित होती है। खास करके सरकार की 9 सूत्री योजना जो प्रस्तुत की गई, जिसमें कृषि उत्पादकता, रोजगार और कौशल प्रशिक्षण, आर्थिक विकास, समावेशी मानव संसाधन विकास और सामाजिक न्याय पर उन्होंने पूरा बजट केंद्रित किया है। निश्चित रूप से यशस्वी प्रधानमंत्री के नेतृत्व में भारत दुनिया में अपनी एक नई पहचान कायम करेगा। ये बजट मध्य प्रदेश को भी अपने विकास के साथ कदम से कदम मिलाने के लिए मौका देगा। विकसित भारत में ही विकसित मध्य प्रदेश की संभावना भी छिपी हुई है।
You should be aware that this is actually a tax measure. It's not really a money laundering issue, but money laundering issue was being tackled through a tax measure. So first of all, I want to clarify that this tax, there are other provisions in the income tax itself. First of all, to find out the source of these funds. Number two, there is already, the Prevention of Money Laundering Act, which continues to be in existence. So if there is money which is being laundered, money, being paid as a bribe or for use in, other purposes for terrorism, etc., there are enough laws, including the Nyaya Sahita, Bharatiya Nyaya Sahita and the Prevention of Money Laundering Act to take care of those issues. While on the other hand, now some genuine money for investment, actually, there is this deterrent provision no longer exists, while provisions for money laundering remain, and they should be sufficient to cater to it.
I would add that there are also certain provisions of the Companies Act which can be invoked if there is deliberate undervaluation of shares. So there are other legal remedies. The balance here is between preventing money laundering but accidentally also preventing investment. So that balance is what we are seeking to get it right.
211 backside. Yeah.
Hello, ma'am. Prakash Predashi from ET Now. My question is, will the increased STT be applicable from April 1 or prospective? And if from April 1, will there be retrospective tax calculation for the increased amount?
It's not retrospective. It is with effect from 1st of October 2024. So we are giving sufficient time for the exchanges and the people, who collect this tax to put their systems in place to be able to collect it. It's not retrospective. It is prospective.
13. 11. 11.
Ma'am, Karishma here from Business Today. Ma'am, congratulations to you and everybody. Ma'am, my question is on this special assistance to Andhra Pradesh and Bihar. 15,000 crore is the number that you've given for Andhra Pradesh for this financial year. Is there further assistance that you are looking at, or is it going to be need-based in terms of the amount?
I've already mentioned in the budget speech that 15,000 crore is coming through the multilateral development assistance, which we borrow from the multilateral banks, whether it is World Bank or ADB or AIB, whatever. And I've also ended that paragraph by saying further assistance will also be extended.
There is no definitive amount.
No.
152.
मैम आलोक प्रियदर्शी फ्रॉम सीएनबीसी आवाज में मैम सवाल यही है कि जिस तरह से आप लोग न्यू टैक्स रिजीम को प्रमोट कर रहे हैं, इस बार भी आप लोगों ने स्लैब में चेंज किया, स्टैंडर्ड डिडक्शन बढ़ाया, तो ये मान के चलें कि न्यू टैक्स रिजीम के जरिए आप मिडिल क्लास को राहत देने की कोशिश की है इस बार। ओल्ड टैक्स रिजीम को लेकर क्या कोई सनसेट क्लॉज है? क्योंकि आपने कहा है कि जो इनकम टैक्स एक्ट है उसका हम लोग कंप्रेहेंसिव रिव्यू करेंगे, तो रिव्यू में क्या ये मान के चले कोई सनसेट टाइम आएगा ओल्ड टैक्स रिजीम को लेकर?
अभी मैं बोल नहीं सकती हूँ। जरूर हमारी इरादा ये है कि सिंपलर टैक्सेशन रजीम होना चाहिए, और सिंपल टैक्स रजीम की ओर अगर हम जा रहे हैं ये रिव्यू के द्वारा, वो ही हमारी मकसद होगा कि सिंपल कर दो। ओल्ड टैक्स रजीम को सिंपल करने के रास्ते पर ही ये नया टैक्स रजीम आया है। सनसेट होगा कि नहीं होगा वो अभी मैं बोल नहीं सकती हूँ, वो रिव्यू करने के बाद ही हम एक डिसीजन लेंगे।
और ये एक आंकड़ा मैं आपको दे दूं कि इस बार पिछली बार जो हमने परिवर्तन किए थे नई टैक्स प्रणाली में, तो 70% लोग अभी तक जो 4 करोड़ के लगभग हमारे पास में रिटर्न प्राप्त हुए हैं पिछले वर्ष के, 70% ने इसको प्रेफर किया है बनिस्बत की पुरानी प्रणाली को। तो बड़ी तेजी से लोग नई प्रणाली की ओर आकर्षित हो रहे हैं और हमारा यही प्रयास रहेगा।
Yes. Ongoing filing period. Not yet.
I mean, more returns are coming in. Yes.
271.
Hi, ma'am. This is Sumit Chaturvedi, ET Now. Ma'am, the corporate tax for foreign companies has been slashed to 35%. I want to understand the broad intent of this intention behind this decision, and what kind of benefits to economy increase in investment you are expecting.
You've in your own question answered it. We want more investment to come into this country, so that is why it has been brought down.
95.
Just to add to that, there was a widened differential between foreign and domestic companies which arose after the tax cut in 2019. When the domestic rates were cut, the foreign rates were not cut. So there was a widening of the gap. With today's change, there is still a higher rate of tax for foreign companies, but it is not now disproportionately higher than domestic. And therefore, this is something where, according to the feedback received from industry, we expect more foreign companies to invest now that this regime is adjusted in this manner.
Good evening, ma'am. This is Par Singh from Outlook Business. Yeah. You have earmarked a significant allocation towards rural infrastructure today. So how much of a boost to consumption and overall demand are we expecting here from this allocation? Have any?
So it is difficult to quantify what would be the accretion to demand coming from. I mean, the obvious increase is whatever we have increased. But yes, would there be a multiplier? Probably yes. I think with the Awas Yojana Gramin and the Gram Sadak Yojana, these two do have a lot of multiplier effects as well. Traditionally, for capital expenditure, the multiplier has been calculated at somewhere around 2.5 to 3. In the Awas Yojana, it may be a little lower. But yes, there would be a substantial multiplier. I don't have a precise calculation.
But other than the Awas Yojana and Sadak Yojana, Gram Sadak Yojana, there's a major push towards the corridors. For instance, I mentioned in the context of Bihar, I mentioned in the context of Andhra, 2 corridors which are moving, one from Visakhapatnam to Chennai, the other moving from Hyderabad to Bangalore, Buxar, Purnia, and so on, and building of the Gaya node in the Amritsar to Kolkata are all towards building infrastructure in the rural areas in order that we attract more investment and enable transit of goods in those huge corridors. All these are essentially going to the rural areas in a big way. And therefore, it is not just through PM Awas Yojana and Sadak Yojana, but major investments in strengthening the corridors, building nodes, and therefore also in improving the rural infrastructure is happening.
11.
Ma'am, I'm Maria Shakir from NDTV and NDTV Profit. Congratulations for creating history today by becoming the only finance minister for having presented 7 consecutive budgets. Ma'am, my question to you is about the first-timer scheme, because as you said, that employment perhaps sums up the essence of this budget. Would there be more blueprint coming out as to how this first-timers scheme will be playing out, and what will be the role of private sector?
Just 1 minute. See, this Prime Minister's package that I announced has 5 different schemes. The first timers is, I would think, one of the very, very innovative initiative. So what we are doing there is to be able to provide first timers 1 whole month's salary as subsidy. And this will be put into their account as direct benefit transfer, but possibly in tranches. When an employer picks up a first timer, and this is through the EPFO that you get to know that they have paid their provident fund amounts, and therefore the first timer indicator that we are talking about will be established. So they can't just say one of the existing employee is a first timer and claim it. There are enough checks and balances in the system to make sure that indeed the first timer is coming in. And then the first timers will be put through that learning curve, and this will help them to acquire skills so that they become fully productive. This kind of a subsidy giving, 1, you give the first one month salary. 2, you're also giving both for the employee and for the employer subsidy. So the applicable person for whom it is being given may even draw wage up to 1 lakh rupees. But to the extent of 15,000 is what you're giving as a subsidy. The installments, as I said, for the first 1 month wage that you want to give will be done over 3 installments, direct into the first time employee's account. One compulsory measure that we are bringing in there is to make sure that the employee undergoes online financial literacy course before claiming the second installment from the government. So he may be a qualified engineer, he may be a diploma holder, he's a first-time employee in a office, he becomes a first-time employee and the employer also claims that he's been recruited. We try giving him the 15,000 rupees. He may have a salary of 1 lakh, but up to 15,000 rupees is what we are going to give. And in that, if you're giving 3 installments, the first installment will be given. But before he draws the second installment, he should undergo an online financial literacy course so that he can claim the second one. So we are not training him in engineering, we are training him in financial literacy. Post that, of course, the place where he goes to work, he's going to be working in any case. Then subsidy to be refunded if in case the employer removes him from the work within 12 months. So the employer gets a subsidy as well, but he will have to refund it if within 12 months this first time employer has been removed out of the work. This will cover, and we expect it to cover 1 crore persons per annum. And the scheme will run for 2 years. So up to 24 months, you can have new employees brought in, new first-time employees brought in, for whom the government will give 15,000 rupees as from our side, 1 month, what we think, 1 month's salary. Although his salary may be any amount, but to a cap of 1 lakh. And then he undergoes some financial literacy course, post which the second installment and the third installments can be withdrawn, put into his account. But most important is if the employer removes him within 12 months, the employer will have to refund the subsidy given to the employer. So that's how that scheme works.
278. If I may just add, details are available in the budget speech in the annexure on page 31. So there are details of all the 5 schemes in this package. If you go through them, there's considerable amount of detail which you can get.
Hi, good evening. This is Priyashmita from Informist. I have 2 points from the budget that I would like to ask. The first is nominal GDP has been pegged at 10.5%. And we have seen that growth is on a high momentum, and even the RBI has pegged growth at 7.2%. And the Econ survey said that it is going to be between 6.5 to 7%. So a 10.5% nominal GDP looks a little conservative. What is your view on it? And the second is that there's a mention that beyond FY26, you would want to reduce your debt to GDP. And you've mentioned that the 4% debt to GDP it's a thing of the past. So what do you think is a sustainable debt to GDP or a desirable debt to GDP?
Well, that was the finance minister answering some very important questions raised on long-term capital gains, on the lack of indexation available anymore for the sale of real estate and the LTCG that will be applicable. Yes, the long-term capital gains has come down for real estate, but indexation gains may not be available. But there are many fine points because the house price can be reset to 2001 levels, we are told. There is a lot of tax clarifications that we need on all the long-term and short-term capital gains changes that have been announced. There are a bunch of STT announcements. For all these details, we are being joined by one tax expert who's perhaps the best of them all. Joining me now is Mr. Dinesh Kanabar of Dhruva Advisors. Mr. Kanabar, thank you very much once again. You've really given us a lot of time here to the Network 18 group. Well, for starters, can you clarify on real estate? Because there are stock market and non-stock market people interested in this issue. What is the advantage or disadvantage with LTCG or real estate not getting indexation, but long-term capital gains tax getting reduced?
So thank you, Lata, for having me. A couple of quick points. First, the period of holding a real estate to qualify for long-term has now been reduced from 36 to 24 months, which means that if you hold a real estate for just 2 years and you sell it, then you would be entitled to qualify as long-term capital gains, and therefore the rate of tax of 12.5 would apply instead of the higher rate which was applicable today. So that's point number one. Point number two is that, as you mentioned rightly, Lata, we do not have any benefit of indexation now. And that would mean really that, so what did indexation do? Indexation ensured that what was being taxed was the excess which you got beyond inflation. Your inflation was protected, and there were gains beyond that, only that you paid tax. Now, today, when government does not grant you indexation, you are paying tax even on a notional inflation, which is not really warranted. That said, as you mentioned earlier, and you and I had spoken earlier, the reset of the cost base to 1st April 2001 continues. So indexation is applicable only in respect of cost. As at 2001, you apply the indexation to it. Now that continues. Therefore, instead of the cost of acquisition, you take the market value of the asset as at 1st April 2001. But however, the indexation applicable thereafter, which would be approximately a multiple of 3, is gone.
Okay.
Mr.
Kanabar, may I interrupt you? May I interrupt you? Let us take two concrete examples. Okay. I have my father's house bought at 50,000 rupees in 1970, and I am selling it 54 years later in 2024. And I have my house, which I bought in 2007 for say 5 lakhs, and I am selling it for say 50 lakhs in 2024. How will the tax work for the 50,000 house going for probably 50 lakh today, and the 15 lakh house going for 50 lakh today?
So in respect of the father's house, you take the market value of the house as at 1st April 2001, and that will form your cost base. So when you compute the capital gains, you take the sale value, and from the sale, you reduce the market value as at 1st April 2001. The second house was purchased after 2001. So from 50 lakhs, you would reduce 15 lakhs and pay tax on that. No indexation would be available for period beyond 2001.
Okay. But in both cases, if I used the money from selling the old house to buy a new house, I don't pay any tax?
Absolutely. Provided, of course, that you do not own more than 2 houses.
Fair enough. Fair enough. Okay, now let me toss the same question to my guest, Nilesh Shah of Envision Capital, who has just joined us. Please don't go away, Mr. Kanabar, because there are lots of tax questions. Nilesh, thank you very much for your time, and you've been really generous with your time and your explanations. Real estate stocks went down today. But what Mr. Kanabar explains is that if I'm going to sell my old house to buy a new house, then I'm not my situation status quo ante remains. Then why are real estate stocks going down? Fresh buyers should continue.
I think it's just more a knee-jerk reaction. Okay. I don't think it's anything to do with essentially, this change impacting them. If at all, it's quite possible that because of this, actually the resale of houses may actually slow down a bit.
Okay.
And actually there might be demand for new homes.
Okay.
Okay. So to that extent, actually this in no way negatively impacts any of the real estate companies, but I still think it's just more a sentimental impact.
Okay. Why don't you wear your personal finance cap and tell me, because this was one interpretation I got from someone, that people invest their money in gold, in shares, in debentures, and in real estate. So far in real estate, you got an indexation and a long-term capital gains benefit. Now you get only one. So in comparison to other asset classes, real estate has lost its lure, which is why the stocks have fallen. Is that a fair?
I'm not sure if it's fair, because at least in real estate, they still have one additional benefit, that if you reinvest the proceeds, then there is no
tax at all.
Whereas in shares, if you reinvest the proceeds, you still pay tax.
That's true.
Okay. So it still looks like, if I were to kind of look at it, real estate essentially is still favored relatively versus equities. Gold, the cost has been brought down.
Yes.
So if you really look at it from all of that today, from
real estate should not complain.
Real estate actually should not be contained.
Okay. Now, that said, why don't you come with some concrete advice? Would you buy real estate stocks today?
I think so. Yeah, I mean, not necessarily. It would all depend upon what kind of at what price, but I wouldn't be negative on real estate because of today's announcement.
Okay, irrespective of today, where do you stand? Is that one of the set of stocks that you are attracted to?
Yeah, I think that is one. Two is basically this again, the budget benefits the gold, right? Because gold prices are down. It benefits the jewelry companies. Hopefully, gold prices have come off today, which will trigger a kind of a consumer demand for jewelry. So anyway, gold jewelry as a space was looking good for the long term. But I just feel that today's announcements really kind of makes them even attractive in the very short term as well.
Fair enough. Okay, now let me come to the other important stock market rules that have changed. The LTCG has now been raised, short-term capital gains has been raised from 15% to 20%, and long-term capital gains have come down gone up from 10 to 12 and a half. It's come down for real estate. It's gone up for stocks. So stocks, there is an increase both sides. Now, Mr. Kanabar, anything further that we should know about stocks? STT has also gone up. So basically, you would say a stock investor is getting taxed more. Is that right?
That's right. So two things. One is 10 has gone to 12.5 STT. Therefore, you are paying both the transaction tax, which is at a higher rate, and you are paying capital gains tax, which is at a higher rate. But Lata, much as one may talk about it in today's date and time, or for that matter at any date and time, would you regard that 12 months is long term? I mean, the fact that we are looking at stocks as just held for a year as being long term and therefore being subjected to a lower rate of tax itself is good enough. So while the rate has gone up by 25%, I don't think it is earth shattering, particularly when one considers how the market has been moving over a period of time.
Okay. Yeah. And after all, the aim of the government has been to tone down the exuberance. So perhaps that point is well taken. Mr. Dinesh Kanabar, thank you very much indeed for joining us with all your thoughts. Is there any last point you want to add?
No, the only other thing I would say is that, Lata, when you and I were speaking very early this morning, which was with regard to litigation, and I think there are enough and more things out here on litigation. One is a simple announcement that tax assessment will not be reopened for 10 years, but only for 5 years, which itself should give a lot of people peace of mind to say, once my assessment is complete, I can breathe a sigh of relief. And then, of course, we'll await the VSV scheme and how does the settlement scheme work to reduce the litigation. Very, very welcome.
Okay, fair enough. Yeah, litigation is welcome because I think in this country, not just on tax, but on everything, it is the lower courts in the litigation that have pulled us down seriously. So any even minor reform in that to that end is important. Thank you very much, Mr. Kanabar, for joining us.
Thank
With that, let me come to you, Nilesh. The market was surprisingly mature in the reaction to the higher short-term capital gains and the higher long-term capital gains. Do you think it is just short-term position adjustment and the market will continue to show its kind of sulking because of the higher tax, or do you think it has moved on?
No, I think it has moved on. There was that initial knee-jerk reaction when post the announcement. I think markets were down about 1.5%, 1.5%. And it was like a kind of a knee-jerk reaction. It's pretty much kind of reaction that we saw at the time of the election result. Of course, that time the cut was much more deeper, but the bounce back was very sharp. Probably the bounce back happened the next day. Today, we've seen the bounce back on the very same day. I think it's more about the event is out of the way. The murmur around tax rates going up for capital gains were doing the rounds, and it's like it's come, it's happened, it's gone. Okay, and I think now market is beginning to focus on saying, okay, now we are off to the earnings season. The budget has been good, that there has really been no populism. There have been no freebies handed out. The whole commitment to infrastructure spending remains. There's a huge focus on urban housing, which can have a multiplier effect on the economy. I think if I remember the numbers, it was something like 10 lakh, 11 lakh crore, which is there. Those are like kind of humongous numbers, which will do a lot more good to the economy. So I think the market is probably trying to now just kind of focus back on that.
Yeah, I'm just trying to get the number of houses. I think there was some
It's about
PMAY itself is 1 crore.
Correct. So 1 crore.
I remember that. I even saw 3 crore number somewhere. So housing clearly has got a huge fillip. And along with that, would you be positive? I mean, what would it make you positive on? I'll just read out. Urban housing under the PM Awas Yojana 2.01 crore urban poor middle class families will be addressed with an investment of 10 lakh. And in addition, there is also a subsidy for the loan subvention. So, uh, do you go to the Aadhars and the Avases for this, or would you go for the cement companies, or would you go for the century ply kind of people who will be inevitably used in a new house? What are your favorites?
I think, Lata, all. Clearly, the affordable housing finance companies are like kind of the direct, straightforward beneficiaries of this. I just think the market opportunity for them gets a lot more fast forwarded, and that will help them to kind of grow in very strong, high double digits. Okay, as long as, of course, they manage their loan book well. The second would be the building material guys, including the cement guys. So cement, tiles, plywood, construction chemicals, adhesives, all of that. That entire pack gets benefited quite significantly. So it's essentially these two pockets which benefit quite phenomenally with this.
Okay. You know the valuations of many of these companies. Where are you more inclined to find attractive valuations?
I still think in context of the growth and the capital efficiency, I still think affordable housing finance is a much better space to be in, because some of the building material companies and stocks are like really on the higher side in terms of valuations.
Okay.
The leaders in that, be it the leading tiles company or the leading adhesives company, these are all trading at 40, 50, 60 time P multiples. Okay.
Yeah.
And it's not that this opportunity is going to remain for the next 10, 20 years. They'll probably have a gush of opportunity for maybe the next 2, 3 years. Whereas versus that affordable housing finance, you write a loan, you make money for the next 10 years, 15 years, 20 years.
Okay.
So that's why I think I would still kind of go with affordable housing finance space.
Okay. I think we are joined by Rajesh Srinivasan. Do we have him? Okay, I think I'll go to Rajesh. Okay, we'll get Rajesh in a minute, because tax is always attractive. But I wanted to ask you also, why did bank stocks fall so much? As you say, housing financiers are benefited. Now, I would assume PSU banks are also lenders at the PMAY level. At least small banks would be. Now, Jana Small Finance has fallen. Small finance banks have also fallen today. Is there any explanation, or is it just position squaring?
I think it must be just position squaring. I don't think it's got anything to do with any direct impact on them.
Okay.
If you
Nifty
really
Bank is down 1%.
which is very surprising, because look at it. I think for the bank Nifty today, what would have been the most relevant? It would have been the number on fiscal deficit,
Yes.
which I think has been good, 4.9, 4.5. That's honestly very cheerful, but very surprisingly that they're down. It's also possible because the numbers, the growth is not yet very high. I mean, these are banks which are still kind of growing at in a band of 10 to 15%.
Yes.
And the smaller banks, the fintechs, the NBFCs, they're growing at a much faster pace. So probably fresh allocations are not going into the big banks. The fresh allocations are going into all these satellite sectors, satellite positions.
No, fair point. I guess the market was also hoping that something in the whole grammar will change to make life a little easier for the banks to collect deposits. That doesn't seem to be the case. And I'll just, since I have a fixed income bias, I might tell you that although the fiscal deficit has come down, the government borrowing, which was 14.1, has become 14.01. So they've only lessened the borrowing by about 9,000 crores. So the bonds did not react much. It's down by 1 basis point, which is still positive. But there is a bit of a jump in the overnight index swaps, indicating the bond markets are happy. The fiscal deficit is lower, but immediately the government is not borrowing less. But be that as it may, you've seen the HDFC Bank results, you've seen the Kotak Bank numbers. Are you attracted to the big banks?
Honestly, Lata, I can't say one is attractive. It's not like a situation where you want to kind of go overweight on them.
Compelling buy.
Okay. And that's because maybe the smaller banks and some of the NBFCs, some of the fintechs, some of the affordable housing finance companies probably still are a relatively better place to be in. Okay. So it's not yet a situation where you want to go terribly overweight on.
Fair enough. But any choice between PSU and public sector?
I think private. I think private banks.
Okay.
Clearly private
There is
banks.
something about mudra loans and some responsibility which is more for PSU banks. But I'll have to read the fine print over there. I'll come back to you in just a minute. We've got Rajesh Srinivasan, the tax expert, joining us. Rajesh, thank you very much, and thank you for your patience. We've been trying the phone lines for some time now. well, there are a lot of minutiae of tax changes. According to you, what is the one that stands out in terms of impact on the economy or impact on corporates?
I think if I have to look at it from the corporate perspective, I think there's a lot more that needs to be done because if I must talk about bringing out the direct tax code, as of now, some basic changes are being made. Rationalization of TDS is one significant thing. And also with regard to the reassessment period being brought down to 6 years as against 10 years, I think that's another significant move. However, I think we have to wait for the direct tax code to really bring out the ease of doing business in India. I think there is a lot that needs to be done on the tax front to improve our ranking over there.
Mm-hmm. So you're saying that the promise of the direct tax code reform is a big one, something to look forward to.
Okay. That's true.
Okay. Okay. Is there anything else? I mean, we were expecting something on BEPS as well. Is there anything in terms of taxation over there that will come or has not come? Any disappointments?
Yeah, I think we thought that there would be support for newer manufacturing entities. We had a lower tax rate of 15% for the new manufacturing entities being set up. In order to further push the manufacturing activity, we were hoping that that would be extended for another couple of years. Maybe government is also under pressure on the collections. I think the corporate tax collections have been lower than the personal tax collection as far as the percentage of growth is concerned. Could be because of the lack of flexibility on the finance side. I think government has not been able to offer more on the tax front. That is one part of it. See, people are not only expecting the change in tax rate, they are expecting the certainty with regard to operating in India. I think that's where we need to give a lot of comfort to the investors. I think there we are hoping that the direct tax code will bring in a big change. I think the other thing is with regard to rationalization of capital gains. Again, it's going to increase the tax burden for some of the people. I think it's more of a balancing act where you increase the collections on one side, and the other side you also reduce the impact that would be there, but not significant. I think there has not been significant change with regard to the fundamental aspects. The other aspect is with regard to again VSPV. Whether that would help in eliminating or reducing the pending tax disputes. That's one more option that would be available. That's more to clear the past issues. I think we also have to look at how we are going to create a very transparent and simplified tax policy as well as administration going forward. I think that's going to be critical because our tax system has been to allow people to move forward without bothering too much about the past, particularly for the compliant taxpayers. So wherever we are seeing the challenges on the compliance, then there could be action on the past. But otherwise, we should allow the business to look up for the future. I think that's change will have to come through the direct tax code. It definitely requires a complete overhaul of our direct tax system.
Fair point, fair point. And very quickly, Rajesh, one last question. What about that the TCS, tax collected at source, getting adjusted in our salary payments itself? Would you think that is important? Because a lot of people who only pay, file their returns at the end of the year. If you went on a foreign holiday or had more than a 7 lakh credit card payment, then you ended up losing 20%, which you can get back, but you get back after 1 year. That getting adjusted earlier is a big positive, you would think?
Yeah, these are all the irritants that have been there in the system. It's getting gradually eliminated. If you have to measure some of the things that are being done at these levels, if you see there has been some concession given at the lower income tax bracket. So those things are being done. But I think it calls for a significant change, right? We are giving 10,000 rupees extra deduction for pensioners, right? Those are all benefits that the individuals would enjoy. But I think the people would be expecting a lot more comfort, right? In the sense, 10,000 rupees increase in pension deduction may not be significant for everyone. I think we may have to, but still it would call for compliance. So we got to see how we can eliminate the compliance for senior people. But the overall exemption amount available with all of this, it makes it quite attractive. So these are the positives that are there in the budget bracket, which the government is looking at, either with regard to the employment generation or with regard to the taxes. I think that seems to be the focus in the budget today. But otherwise, I think you would see big changes coming in.
Much, Rajesh Srinivasan, for
pleasure.
Giving us your thoughts. So there's some bit of cleaning up, and then at the lower bracket, there is a little bit of tax relief, both in terms of standard deduction and in terms of LTCG also. I mean, capital gains also, the amount that is excused, the cap goes up to 1,25,000.
Yes.
Thanks a lot, Rajesh, for that.
Sure. Okay.
Question
so
based on that to you, Nilesh. Which part of the consumption basket are you attracted to? There is a little more money in the hands of people.
Yeah.
And, there is, of course, those employment schemes, etc., which hopefully will mean a little more of transfer of income in course of time. Nothing is going immediately. I mean, we don't have a PM Jan Kalyan or PM Kisan Samman Nidhi or anything putting immediate money. But are you attracted to consumer, personal products, FMCG, or are you attracted to the consumer discretionary?
I think it's a mix of both. But I think the broader theme being more about premiumization. I think wherever you see an element of premiumization or basically demand getting driven by more aspirations, I think that's really the space to bet on. What we discussed earlier, gold jewelry as a space, I think that's a very interesting space. I still think there are strong tailwinds of growth, a runway of growth for, is there for years to come. The second area, basically in the staples category, I think is dairy as a space looks interesting. I think that's one important area within the overall food basket, which I think is offering interesting opportunities. And the third, of course, is the travel tourism. People still want better experiences, more holidaying. So I think the online travel aggregators, the resort companies, the hotel companies, I think that again is a very interesting space. So I think it's a combination of these things that we like in consumption.
Okay, no, actually you're very right about tourism. There is a lot of money that's been sanctioned to Bodhi Gaya and Gaya. And we may see, like Ayodhya, yet another, and Varanasi, another tourist spot coming. And I know in the past, in anecdotal evidence, in the last couple of years, the number of tourists who have told me they're going to Banaras or they're going to Varanasi or they're going to Ayodhya. So tourism clearly for travel companies and for hotel companies. Another guest is waiting by, but I just want to finish that travel question with you. What would you like in that? Is it the hotel companies? Is it Indian hotels which becomes attractive? I mean, airplanes, there isn't so much.
Yeah. No, I think the what we've been owning for some time is the interesting kind of space. We are watchful of the OTA space, the online travel aggregators. There are a couple of listed names, but I still think right now valuations are on the higher side. But if
You're referring to Easy My Trip. That kind of
yeah, and then we had recently Ixigo, which got listed, so we still don't own Ixigo. But yeah, I think these are some of the interesting space. Maybe the Thomas Cook, etc. These are all basically the guys who are providing travel-related services. So that's an interesting space to watch.
Okay. Now, a final question to you. I know I've really harassed you. What would you tell an investor to expect in terms of returns for the remaining part of this calendar year or even for the next 12 months? Do you think the best is juiced out? Or you think the growth story is intact?
I think if over the last 3 to 5 years, the returns have been more in terms of the high double digits. The returns have been more in the 20s and 30s. Okay, I don't think expectations should be now as high as that. I think returns over the last 3-4 years have had the advantage of a low base. The period between 2018 and 2020 were very difficult times for equity markets, and then you've obviously got returns which came bunched up. I think going forward, probably low teens is a more fair expectation to have.
Okay, low teens. I mean, you expect that, and if you get better than that.
Oh yeah, I mean, obviously, more the merrier.
Okay. Dinesh Shah, it was really a pleasure having you with us.
Thank
you very much for hand-holding us right from morning. Okay, so that's the message. Don't expect outlandish gains, but this budget has not done anything to deter stocks. Yes, there is a little more capital gains tax that you'll have to pay, both short term and long term. But regardless, the market has marched on. A little bit of your gains will go as tax, but that's only 5% more if you look at it that way. Okay, with that, let me invite Mr. Sudhin Choksi, formerly of Griha Finance, to join us. He's absolutely the veteran of affordable housing. Mr. Choksi, it's such a pleasure to have you once again with us. Let me start by asking you, what did you make of the PMAY announcement? Would you say that for housing finance companies, especially low-cost housing finance companies, the budget is a good one?
Yes, Lata, I fully agree. The budget will prove very good for the housing finance companies, especially the affordable housing finance companies. I think more than housing finance companies, I am more pleased with the government's very extensive focus on the housing which they have brought in this particular budget. It is not only those 3 crore which they will bring it under the PMAY, but they want to also extend a support to 1 crore urban poor and urban middle class families. Besides, they are going to also encourage the states to reduce the stamp duty and also encourage a lower stamp duty for the women home ownership. And I also heard that they would be also doing something on the rental regulation and rental housing at urban locations. I think this is quite an extensive, focus of the government I've seen in one single budget. So I'm very pleased, from that aspect.
Okay. Would you say that the way in which PMAY functions is good? I'll tell you why. Just before we went into the budget, we had looked for how many people are availing of the PMAY. And, we found that of the, for instance, in HDFC, this is before Griha Finance got merged into the whole, into Bandhan. The experience was that only 27% of eligible loans, about 64,000 crore were eligible, but only 27% actually availed of PMAY. And HDFC was the best performer. Griha Finance, of course, was best at 55%. But if you came to SBI, ICICI, the people who availed were much lower, about 13% and 6%, as low as that. What's going wrong? Is PMAY very difficult to access, Mr. Choksi?
No, it has not been very difficult to access. I think, PMAY is quite easy. I think if you look at the NHB records, because, the interest subsidy does, comes only through NHB. Okay. And therefore, if you look at NHB's support in this regard, I think it's been very good. I think they have probably given more than 20 to 30 lakhs of, home borrowers the interest subsidy under the PMAY. And as you know, PMAY is not only in respect of the interest subsidy. There are other self-construction beneficiaries also get subsidy directly from the state governments. And besides, the government themselves have been undertaking the construction for economically weaker section. And I think on those two parameters, one, there's government construction and the self beneficiary construction, I think the number or the progress has been wonderful. So I think PMAY, I think we'll have to wait and watch this 3 crore housing which they have announced, under which of this pillar or under which of the tenant, they will get a benefit of the PMAY scheme.
Okay. And would you say that this also gives fillip to employment? I mean, we have found lately that infrastructure in the form of highways is not necessarily very labor intensive because there are mostly prefabricated bridges. It's not as employment intensive as it used to be, say, 40, 50 years ago. But housing, we are told, is still employment intensive. What's your take?
No, there is no doubt, Lata. We have seen over the number of years, housing has been proven to be the engine of the economy, and therefore this kind of support definitely will give a boost to the employment, especially the unskilled labor. And besides, I think the kind of the program which the government has announced on the employment side and the skilling side, I think all this is going to translate into, quite a good positive for the economy overall.
Okay. Okay. Well, stay on, Mr. Choksi, if you don't mind. I have another economist joining me to give us his sense of the big numbers in the budget, the revenues, the tax buoyancy, and above all, of course, the fiscal deficit. Joining me is Kaushik Das, the chief economist at Deutsche India. Kaushik, thank you very much indeed for sparing time for us yet again today. You helped us with the big numbers in the morning as well. Now, the government has done a little better than you thought. I think you said 5% is your expectation. They have done 4.9. Would you give it a AAA?
Yeah, I mean, there are different ways to look at it from an economist point of view, particularly if you're in the fixed income market. It's the best budget that you could have wanted from a fiscal deficit consolidation point of view. I kept on telling you even yesterday when we did the economic survey that I was the most optimistic among the panelists, and I thought like our official forecast was 5, but we thought like it could go down to 4.9%. And if you see the double decimal, it's 4.94. So it's more or less in line with what I had expected. And the whole idea was that whatever extra dividend that they had got from RBI, they will not spend the entire amount, and they'll probably spend half of that for expenditure, and then the remaining part would be used for fiscal consolidation, which is exactly what has happened. The only thing is, from the market point of view, if the gross market borrowing and net market borrowing had reduced meaningfully, that would have led markets to kind of rally, particularly 10-year bond deals. That hasn't happened because the gross and net market borrowing has changed only marginally, and they managed it through T-bills and cash balances. So that's the only part which has not kind of made the markets rally, even with a 4.9% fiscal deficit number. But from a macro point of view, these numbers look excellent.
Yeah, actually, they have not reduced the borrowing. I agree. 14.1 lakh crore was the gross borrowing. It's come to, I think, 14.01 lakh crore now. So just
hardly,
a few 9,000
crores
less.
Net market borrowing.
Yeah, net borrowing, exactly. So would you say that they're probably preserving the best for the end? That at the end, you may see the government borrowing program getting, reduced next year, because your math is better. And why I'm asking you this question is, have they underestimated tax collections? They have said that because of the tax giveaways, they lose 37,000 crore, but because of the tax increases, they are getting in 30,000 crores, and therefore they are about negative in 7,000 crore. But my sense is STT has gone up, LTCG has gone up, STCG, I mean, short-term capital gains and long-term capital gains on shares has gone up. So, and of course, indexation goes away for real estate. All told, the government may be more in the money at the end of the year. So do you think we can retain a hope of government borrowing coming down?
So, Lata, if you see last few years, whatever the government had estimated, first of all, they always estimate on a conservative basis. So even this 10.5% nominal GDP growth can be higher this year. But let's assume that 10.5% is what we'll get. Even then, the 11% net tax revenue growth that they've assumed, I think that's on the conservative side. You could end up getting more, even from the tax collection point of view. One thing which could disappoint a bit, or maybe not, but at this stage, there's no way to know. It is the disinvestment target of 50,000 crore. Last time also it was lower. But if you add everything together, I think there is a possibility that instead of 4.9, you could end up even getting better by the end of the year, maybe 4.8, that kind of a handle. If you look at FY24, we started with 5.9 and we ended up getting 5.6, and that is without the RBI dividend. It is just tax going up more than what we had expected, and expenditure ending up being a little lower. Also, I feel that the 11.1 trillion that they have kept as capital expenditure may be difficult to spend even in these 8 months of the fiscal year. So there could be some savings from there as well. So all told, my feeling is that this 4.94 could end up getting into the 4.8% handle. And to that extent, what you're asking, that decision will only be taken probably in December or January of next year, whether they can reduce some market borrowing or not. Could happen, and I'll not rule that out. But even if market borrowing is not reduced, if you get a lower fiscal deficit at the end of the year, then it makes it even easier not only to achieve 4.5 next year. Now it is looking like you can go down to 4.2, 4.3 in FY26. And what that means is that if you add that 4.2 or 4.3 for next year, along with say a 2.8% fiscal deficit for the states, you are possibly going to go down below 7% fiscal deficit for the center and state as a whole, which can open up room for discussion for a ratings upgrade for India, which I've been saying continuously that this kind of fiscal consolidation paves the way for a ratings upgrade eventually. Not this year, but maybe next year you could have a serious discussion on that.
Okay, that's very big. I mean, my sense also is that we are perhaps on the way to a ratings upgrade. We have clearly, general government deficit is now going very clearly below the 8% mark. We are going to have 4.9 plus maybe at best 2.8, 2.9. The states normally don't deliver the deficit that they declare in their budgets. So assuming 2.9 over there, we have come down to 7.8. And I guess if we come down to 7, we could well be on the way to an upgrade. Kaushik, just hold on for a minute. We still have Mr. Sudhin Choksi with us. Mr. Choksi, would it be a big disappointment that the interest set off on taxes is not increased for a very, very long time? We continue to have, at 1.5 lakh rupees. Do you think that that would have moved the needle a lot in terms of housing finance or housing loans?
Yes, I think the government should have looked at that element and given some kind of incentive or encouragement or relief in the repayment of the loans. I agree. But I think in the scheme of the things, I think that becomes a little smaller component compared to the larger picture which they have been trying to draw.
Okay. More broadly, how are you looking at the health of the real estate companies? I mean, they were, of course, in the pink of health after all the asset quality review and cleanup of bank balance sheets. But you think real estate companies are in a fine spot? I mean, I know I'm not trying to ask you a stock market question in terms of whether you will buy real estate stocks. But more broadly, do you think that real estate is in a better shape after this budget?
No, I think they'll continue to be in a good spot. I think for over the last 2 years, the real estate companies across the nation, I think they all have been doing well. There has been a good demand. And I think with this kind of a thrust and the focus which government has been bringing on a housing, I think they will tend to gain and the momentum will continue. I mean, I see all positivity as far as housing is concerned, whether at a high end of the market or whether at a low end of the market.
Low end of the market. Fair enough. Thank you very much, Mr. Choksi. Always a pleasure listening to you. And when from someone like Sudhin Choksi, then that's a compliment that the government should treasure. It comes from someone who knows. Back to Kaushik Das, our macroeconomic expert. Kaushik, the assumption of the nominal GDP is 10.5%. And yesterday we discussed at length the real GDP assumption of the government at 6.5 to 7. Do you think both are underestimated?
Yeah, I think this Ministry of Finance team of people are starting generally with a conservative estimate every year, because the approach is that you don't want to kind of start off with a very optimistic number and then you're struggling to kind of manage the fiscal deficit. It's better to start with a conservative estimate and then you get a positive surprise market like that. So I approach 6.5 to 7%. As I told you, this year we have a 6.9% forecast. So possibly it will be at the upper end of the range that the CA has kind of indicated. And if you add at least another 4% GDP deflator on top of that, close to 7% real GDP, you could come closer to 11% compared to the 10.5% that they have indicated. which means that the net tax revenue growth that they've taken at 11%, round about those levels, could be higher, with a nominal GDP growth coming closer to 11% instead of 10.5%. We've seen how the tax buoyancy has played out in the last few years. So I think the momentum would remain strong for tax collection. The disinvestments are the only, component which we don't know whether it can be lower. Sometimes what happens is, if you haven't been able to do disinvestments in the last few years, you could have a bunched up impact, and this year could be better. You never know about this number, but they have kept it at 50,000 crore. I've assumed a little lower number, around 35,000 crore this financial year. But overall, I think you could have an upside on the revenue front. On the expenditure, as I told you, maybe that 11.1 trillion already has a inbuilt buffer of savings in it, because they may not be able to spend the entire amount. Last year, FY24, the whole year, they spent 9.5 trillion INR. So in this 8 months, spending close to 11 trillion might be difficult. So there could be some savings, there. But what could also happen is that revenue expenditure, whatever assumption has been made as of now, in December, when Finance Minister presents the supplementary demand for grants, there could be some increases based on how things play out between now, the monsoon, and other factors. So overall, I think there is a possibility of doing better on the fiscal deficit front, and instead of 494, you can end up getting closer to maybe 490 or the 489 handle kind of a number, which may not lead to reduction in market borrowing immediately, but they can adjust it to different other means. But this will set the tone for next year. And when we go to 1st February, expecting for the budget for FY26, I think people would build in a possibility of 4.2, 4.3 kind of fiscal deficit number. And if you think of it, before this whole system of taking off balance sheet into the budget and adding it as expenditure, our fiscal deficit, if I remember clearly, it was around 4% or something, or slightly lower, that we had come down to before COVID. So if you add about 1% on top of that, which was sitting as off balance sheet, we were actually at about 4.2, 4.3. So we are going to go down to that 4.2, 4.3, which is the pre-COVID level next year. And if you add about 2.8% of state fiscal deficit, we could actually be below 7% of GDP after a long time, and that could open up the room for ratings upgrade, as I'm telling you.
No, you're absolutely right. Both on FCI and NHAI, the government had parked a lot of its what should legitimately be budgetary expenditure under these heads, and therefore the fiscal deficit tended to be understated in the pre-COVID years. And
Lata, do you remember what was the number before COVID? What was the lowest point that we achieved? Was it 3.5 or 3.7?
No, I don't think we went that low, did we? I mean, I don't remember that very clearly. I remember only from the 6.4, which was, of course, a very big number in the post-COVID. But I can maybe get back to you. I don't think we went below 4, but I'll get back to you
whatever
on that.
Number is,
let me just
whatever that number is, you should add 0.8 or 1% of GDP, which was sitting as off balance sheet, and compare that with the current number, because now everything is on balance sheet. So if you go down below 4.5, that is probably better than what we were with the off balance sheet being added.
Okay. No, I'll come back to you with the previous budget numbers in just a minute. Let me get a final answer from you before I go to Ashok Wadhwa, who's joining us in just a minute. I wanted to know from you, what is the multiplier effect? When we discuss pure economic theory, we always say that if the government spends on houses, it has a multiplier effect, because a whole downstream of cement and housing material, consumer durables get a leg up. Likewise, if the government, if the economy spends more on employment, then again that creates a multiplier effect. And the government has tried its level best to ensure some 1 crore more jobs and employment. At least it's given the incentive. We will have to ask a businessman whether it is, if there is demand enough for that many jobs. But that's a separate matter. Do you think there is multiplier effect enough to keep the economy chugging above 7% in the current year and at least 7% next year?
So the GDP data, Lata, has got distorted because of base effects, GDP deflator being, very low. So you have to, take all this into consideration. So maybe GDP growth is not as high as 8% like we got last year, because the GDP deflator played a big role and it was very low. So we are probably, that's why I think the CA is very kind of realistic when he says that 6.5% growth is what we can assume for a long-term trajectory for India. Sometimes will be higher, sometimes will be lower. So 6.5, 7, I would assume as a realistic GDP growth for India, having taken care of all these distortions. Definitely, there's a multiplier impact. It's difficult to quantify exactly how much it is, but when you have different expenditure happening, which is more productive in nature, like capital expenditure happening from the government side, that will definitely add to employment. What we need more now is to see that the private sector capex picks up. That's $1 million question when it will pick up. We've been waiting for it. Government has done a lot from its own, kitty, whatever they could do without, kind of increasing the fiscal deficit or keeping on the path of fiscal consolidation. But I think over there, the capex of the private sector has already started to increase, but it is only limited to a few conglomerates. So there's a broad basing of capex recovery that is still awaiting. I think, maybe, in the next 6 months, or now that the budget is over and the election uncertainties are over. I know state elections are coming up in some of the major states, but probably next year you'd see the capex becoming much more broad-based from the private sector side. And that itself can add to the multiplier impact that you're talking about and maintain a growth of about 6.5 to 7%. But I would also expect at some point the RBI to step in and try to boost a little bit of consumption from their side, because you can't expect everything from the fiscal side and fiscal consolidation to continue at the same pace. So maybe RBI will step in with some rate cuts and liquidity easing measures to boost consumption at some stage, so that growth remains somewhere between 6.5 to 7 for the foreseeable future.
No, that's a very legitimate, logical conclusion to draw, considering that the Fed itself is speaking about lowering rates, or at least enough disinflation to please them, close to their target. September is now, I think, a 98% vote on the CME Fed watch. And the fiscal deficit also has surprised on the downside. So Reserve Bank has two good reasons to relook at its stance, at least when it meets in August. But let's wait for that. Thank you very much, Kaushik Das, for joining us and parsing the macros, which have turned out to be one of the healthiest performers in the budget today. By the way, Kaushik was right about the fiscal deficit. It was 3.5, 3.3 and 3.4 in the 3 years preceding COVID. Let's now get to the tax. Ultimately, budget is all about taxes. And so we have a tax expert before we wind up the show. Joining me is Ashok Wadhwa, the head of Ambit. Ashok, thank you very much indeed. You've been hand-holding us practically through the day. Well, for you, what stands out as the big tax achievement of this budget?
Listen, I mean, you have two different segments that you were trying to address. One segment that feeds into the Indian consumption story, the large Indian middle class. And we know that consumption in India has been muted. I mean, this engine's been firing on government expenditure, really. And the consumption engine, as I said, has certainly been muted. So you had to address that issue. And then you had the other issue about a very robust, very spoken about capital market, where people have different views. The interesting thing about the market is that if you have 4 people, you'll have 8 views. And we've seen that over the last few days as you played your different sessions here. And I think in one sense, the government has managed to do both. They've taken a little from the capital markets, which is very bullish, and given a little to the middle class market, which really needed the money to support greater consumption. So in that sense, I would say if I look at the two segments that stand out from a tax front, the government has done a good balancing job, right? I mean, you have increased capital gains tax at the cost, I must say, of hurting a sentiment which stability in the rate and regime brought over a very long period of time. But you've chosen to take a little from there, and you've chosen to give a little to the middle class by lowering the tax rates and putting more money in their hands. Obviously, the government feels that supporting consumption at this point of time is more important than kind of addressing the sentiment in the marketplace. And if you kind of see those in a broader perspective, when we were sitting with you in your studio, you were obviously watching the finance minister talk and reacting on the spur of the moment. We've had a chance to sit back. The market has had a chance to sit back. And, at the end of the day, books have to balance out, right? That's the one thing you learn in accounting, that profit and loss and balance sheet in a two-sided accounting have to eventually balance out. And that's what has happened here.
Okay.
And that's what I would say is a good balancing act eventually, Lata.
Yeah, fair point. Actually, the market has reconciled that it will have to pay 20% on short-term capital gains. Yes, if I make 100 rupees, I have to pay not 15 but 20 to the government. But the fact that the market continues to see growth and the fact that it expects that 100 to become maybe 110, 120 in the coming year keeps people attracted. As long as growth is far higher than the incremental tax taken away, I guess people will remain attracted. It is important to keep the growth story alive, and perhaps the government, by putting some money into consumption, has done that.
Don't miss another point over there. They've increased short term from 15 to 20, which is 33%, and which is 5 percentage points. And
incrementally 33%. I agree.
Yeah, and they've taken long term from 10 to 12.5, which is 25 and 2.5% basis points. And the reason I think they've also done that is because the government, rightly so, wants long-only investors to be encouraged. The government has historically said, I don't like hedge. I mean, they've said it, right? That we like people who have long-term investment attitude towards India. And in that sense, even the differential in the rates, they've not taken 15 to 17.5.
Yeah.
They've really deliberately done that to continue encouraging long term.
Okay. Did you get a chance to speak to the Ambit Securities guys or Ambit Capital people? What did they say about the STT increase? The government's aim, of course, is to reduce the volume of F&O trades. And they have, maybe with that end in view, increased the securities transaction tax on futures and on options, almost doubled it from 0.01 to 0.02 or thereabouts. It's still a minor tax, but do you think it moves the needle on volume?
From an institutional desk perspective, they don't care, because honestly, they are dealing with large institutions. And
no, they don't. But will the clients care?
I don't think so. I mean, somebody who is now, it's a signal. It's also a message to say that if the pattern doesn't change, I can increase it again and I can increase it again. So remember, the message is more powerful. The threat is always more powerful than sometimes the action itself. So I would think that it will have some impact, but I don't think it will have significant enough impact. The messaging is really, I think, what government was trying to provide over here. I'll tell you where the institutional desk was more concerned about, and I've tried to clarify that to them, is there was a change in the OFS regulation related to OFSs. Previously, the government had introduced a legislation to say that if you are an unlisted company and you are holding shares which you had acquired prior to 2018, I will allow you to replace it with the cost as on 18 for the determination of what your gain is when you offer the shares in OFS. Right? Because remember, there was a regime, there was a time when as listed shares, where if you decided, if a promoter decided to sell shares as a part of the offering in the IPO, they had to pay tax as an unlisted company. And then the government, in an effort to encourage promoters and for secondary trades to happen, said that even if you offer promoter shares in the public offer, we will treat that as long term, so long as you held it for more than 12 months. And then they introduced a section to say that if you held these shares from before 2018, this was a time when the government was trying to encourage more and more unlisted companies to come to the market. The market was still shallow. They changed it. There was some concern on whether that concession had been withdrawn, along with the concession on indexation. And as Dinesh pointed out during the studio meeting, when it comes to real estate, the 1st April 2001 pricing remains intact. It's the indexation after 2001 for real estate that's been taken away.
That's right.
And they brought the 2018 pricing that was used as a substitute or price when you held it continues to remain. Indexation goes after that.
Okay.
So we've clarified that.
Oh, okay. Yeah, he clarified that. Okay, got that, Ashok. Thank you very much indeed for joining us and giving us the wealth of your, experience, bringing your wealth of your experience to understand budget, to help us understand the budget. Thank you very much indeed for joining us. Okay, so now that was a 360-degree perspective on stocks that we brought for you. We've got tax experts like Ashok Wadhwa, Dinesh Kanabar, Rajesh Srinivasan joining us. We had economists like Kaushik Das. We had stock experts like Nilesh Shah joining us. And we had a housing finance expert like Sudhin Choksi. That 360-degree perspective tells us that there was one big disappointment, yes, in terms of the market having now reconciled itself to paying more capital gains. But the market has reconciled to it. It was a fear after the economic survey raised the worries over exuberant equities. So in a way, the shock was expected, but the market's taken it in its stride, and it's not a very big loss at the end of the day. If you looked at the way shares have ended, the Nifty has ended practically flat. Some of the big beneficiaries have been gold finance companies with customs duty on gold going down. There is also some advantage overall to the macroeconomy because there is a lot of encouragement given to companies to skill more people, to take on more youngsters on their roles, formalization of labor. That will also give a fillip to consumption. There is the big PMAY project, which is at least for 1 crore urban homes. That's expected to give a fillip to a lot of building materials, cement, and housing finance companies. So there is a lot for many sectors and something for the consumer as well in terms of a higher cap on standard deduction. So, well, everyone has got something and everyone has lost a wee bit as well. No disappointments with that budget. That's it on this edition of Understanding the Budget. Let us leave you with some very interesting opinion we got as reactions to the budget.
कहने को आम बजट